What's up, guys? Here I am. I'm going to start my A to Z search of stocks below book value. I'm looking for cigar butts with a margin of safety. And so to start, I'm going to show you guys my screener on FinViz. I'm going to be screening for stocks in the USA. I'm going to be screening for price to book under 1, price to sales under 5, and then debt to equity under 1. And that leaves us with 570 stocks that I'm going to be going through in this video for you guys. A to Z, Chase Ricker. And so here we go. From the top, Audi Bioscience. I'm going to check this one out. Let's take a look at Audi Bioscience, folks. Jesus, $115 million market cap. If we go to their latest filing, we have an asset base of 139 million in assets, 21 in liabilities. Oh, but look at this, folks. We have an accumulated deficit of $252 million. I'm not interested in businesses that lose that much money. That means that they paid in $370 million to start this business, and since the start, they've lost $252 million. That's a joke. I'm not going to be interested in this business. Pass. Next stock, AAME, Atlantic American Corporation. Let's look at the stock price. So to start, Atlantic American hasn't seen much appreciation in the stock price. That's not a good sign. However, in the last quarter, they are profitable. Last 2 quarters, last 3 out of 4, they are profitable. So Atlantic American Corp. Let's take a look at the 10Q. AAME. So their market cap was 37 million, I believe. Let's take another look at this. Yeah, the market cap is 37 million. AAME, they're going to be owning 361 million in assets, 262 million in liabilities. They only have a few million in intangibles, negligible. And so they do have a price to book of about 0.3, but the reason why that might be justified is because they have a very little asset-based margin of safety. So they have, if you lost 25 to 30% of your asset value, you would lose all of your equity here with AAME. Let's actually look at the earnings history of AAME. I mean, one thing I noticed is they actually have retained earnings of 53 million. And it's always a good sign when you have retained earnings greater than the market cap. But those earnings, that's not a lot of earnings over a very long period of time unless they paid them out. But if we go to macro trends, you can see their revenues are actually slightly increasing. And then overall, they are actually generating net income. And then to the tune of about 2 or 3 million a year. All accounted for in the last 12 to 15 years. Not great, guys. But we can see that they generated trailing 12 months of 19 million as recent as 2021. So we're looking at a risky cigar butt with AAME. Probably, I mean, it's real. This bet would depend on if you think earnings will continue. If you think that it's too risky from an asset standpoint, you probably are going to want to be out on AAME, but I think it's going to be enough to mark on my list of riskier cigar butts, AAME, that I don't like. I'm going to say riskier cigar butts that I don't like. AAME makes the list, so we'll leave it like that. Needs more research. Next stock is going to be AAN, Aaron's. And so if we take a look at the 10Q for Aaron's, we're going to be looking at 1.7 billion in assets. We're always going to be wanting to look for businesses that have a horrible return on assets. Keep that in mind. Then they have 1.1 billion in liabilities for an equity of 700 million. But here's the thing, guys. 700 million in equity. But we're going to have to subtract out goodwill and other intangibles to the tune of $155 million. And so our actual equity is going to be $550 million. And so that leaves us quite below book value. But then one peculiar thing that you're going to want to note is that they have a very low amount of retained earnings compared to paid-in capital. And so this is going to be an unproven business from a profit standpoint. If you have retained earnings of 82 million and paid-in capital of 747 million, it's hard to say that you've ever proven that you've made a profit. So let's go to Aaron's earnings history, and I'm going to guess they haven't made a whole lot of money. I mean, it looks like they went public recently. Yeah, AAN went public in 2020. Interesting. I mean, I suppose if they just started the business, those earnings could be hidden. We could be looking at something that is a low multiple. Have they shown? I mean, they did have 12 months of net income above 100 million in 2021. They're not losing a lot of money. They have an okay margin of safety. Back to the balance sheet of 1.6 to a 1.1 ratio. Assets to debt. That's not great. So that's a riskier cigar butt to start with. I'm gonna put it on our list for things not for me. Needs more research. It's always a bad sign, guys, when you see a stock that's selling at such a low price compared to their assets, their asset total, not the equity. So I'm gonna put Aaron at needs more research, and I don't think we'll get too many businesses that end up on there. So leave it there. Very unsure about Aaron's. Ameris Bank Corp, ABCB. We're going to be looking at a bank, folks. ABCB. America's Bank Corp. And so let's take a look. Yeah, 25. Yeah, almost no margin of safety with most banks, guys. Almost no margin of safety with most banks. I'm surprised this made it past my debt to equity screen. But yeah, no equity, including goodwill. Almost no equity. Almost no margin of safety. Skip. Ameris Bank Corp, you're done. ACNT, Ascent Industries. It's going to be a steel stock. ACNT stock. Let's go to their filings. Take a look at the 10Q. And so for Ascent Industries, we have total assets of 215 million, total liabilities of 118. I'm seeing almost 10 in intangible. That puts our equity at 96, make it 86 after your intangibles. They do have retained earnings of 105, which is great, and a very low amount of paid-in capital, too. And so this might be interesting if it's the right price. Ascent, ACNT. Let's take a look. They're at 83, so they're going to be trading at book value. So that's not fantastic from a margin of safety perspective. They're going to be above liquidation value for sure. And so if we look at their revenues, they have been increasing. Let's look at their net incomes and see if we can see any patterns. Not much net income. I think it looks like their losses have leveled out their gains over the last 10 years. That combined with the fact that it's at book value, we're not looking at a mispricing. This is a fairly priced business in most, with a high amount of certainty. Next stock, ACRS. ACRS. Aclaris Therapeutics. Let's take a look at their 10Q. So they have total assets of 218, total liabilities of 62. That's a really good ratio. That's exactly what we're looking for when we're looking for a margin of safety. So let's take a closer look. That leaves us with a total equity of 156 million. But look at this, guys. We have an accumulated deficit of $769 million. What in the world? That's sad. It's sad that a business would lose that much money. Aclaris Therapeutics. I have a feeling this stock is going to zero. Yeah. Yeah, you can't win when you lose 29 million last quarter. Lost 29 the quarter before that. Oh my God, holy crap. So this business just loses way too much money to ever be considered. Next stock, ACT, Enact Holdings. ACT. Let's go to the 10Q. Assets. 6 billion in assets. 1.1 in liabilities. Total equity of 4.5. Okay, but it looks like it's selling at book value because we can see it selling for 4.4 billion right now. They do pay a dividend. ACT. They do have retained earnings too. So let's take a look at earnings. I'm going to guess, guys, that this is going to be fairly valued. Yeah, when it's at book value, Enact Holdings. It's at book value. Let's see if it's at a very low multiple to earnings. If not, we're going to skip. And they are an insurer too, and so in certain periods they will receive more net income than other periods without a change in the business. I mean, guys, we're looking at a cigar butt with consistent earnings. I think I'm going to have to pass solely based off of the fact that it doesn't have an asset-based margin of safety. I'm looking for something that's well below liquidation value. It's not. I think I'm being too generous in looking at earnings at all. But they do have strong net incomes, trailing net income of 679 million. So if you're looking for stocks more priced out of their future earnings, you might want to take a look at ACT. Enact Holdings. You might want to take a look, but that's not for me. I'm looking for something else. Next stock, AIDS, ADES stock. Let's take a look at the 10Q. AIDS. Advanced Emission Solutions. Assets of 230 million, liabilities of 56. So that's a great ratio, guys. They have total equity of 174 million. And they also have retained earnings of 68 million. So AIDS has shown itself to be profitable over time. And very interesting. I'm curious to see the earnings for a stock like this over time. I'll bet they're very unpredictable. I'll bet they're very, very unpredictable. Well, it looks like over the last 10 years, revenues have been somewhat predictable. And then it looks like they had one long period of net income trailed and preceded by periods of losses. AIDS. Very interesting. But let's take a look at the 10Q. 230 in assets with no intangibles, 91 in current, only 22 in currents in liabilities, and then total liabilities of 56. So this stock actually has a really strong margin of safety. Very interesting, folks. Let's take a look at the price. Yeah, this could definitely, folks, qualify for cigar butt status. This stock has a very strong margin of safety. And so this one actually makes our list. AIDS needs more research. AIDS. Yeah, I'm going to add AIDS to stocks to watch, everybody. I don't think we'll get too many on that list. Okay. So, that's AIDS. Very interesting stock. Had a margin of safety in terms of assets. So, next one, ADTH. It's going to be an advertising company. Adthorent. Let's take a look at the 10Q. So 10Q for Adthorent. Total assets of 188 million, total liabilities of 27 million. That's an excellent ratio. Total shareholder equity of 160 million. Okay, so now it's going to really depend. And then we have paid in capital of 89 million, retained earnings of 70. So that's a good sign. Now, let's see. So we've got equity of 160 million, goodwill and intangibles at 45. So we're wiping out 45 of our equity. Our equity becomes 115 million before we consider earning power. And so let's see ADTH. Let's look at their revenues over time. Okay, ADTH. They've been issuing shares. That's a shame. I mean, they do have trailing net income of 17 million. Let's see what the market cap is. ADTH stock. 112 million. Huh. They are losing money. They lost 4 million last quarter. But trailing 12, they are making money. So it was founded in 2011, and then since 2011, we're looking at retained earnings of 70 million with a market cap right now of 110, I believe. It's not the best. So the return on assets over time is very low. But with stockholder equity of 115 after the intangibles are taken out, that actually might make it fairly valued, ADTH stock. Yeah, from an asset standpoint, that takes us to net tangible book value. And we're looking for stuff that's well below net tangible book value. So from an asset standpoint, there is a margin of safety, but it's not near liquidation value. Or it could be if we got back exactly what we paid for everything. ADTH, and then retained earnings. What was the trailing net income again? 17, and I'm guessing if this is going to be an advertising agency, I'm not sure how they're taking their net incomes. It'll take an investigation into their revenues. Let's take a look, folks. ADTH. I might put this on needs more research. Needs more research. Well, yeah, I'm going to put that on needs more research. Okay. ADTN. This is going to be our 10th stock. So let's do ADTATN. AdTran Holdings. Communication equipment. Assets. 1.7 billion in assets. 625 in liabilities. That's not bad. Total equity of 684. But minus our intangibles, folks, we have 700 million in intangibles. So that completely wipes our equity down to nothing. I am therefore not interested. AdTran is eliminated. I cannot buy businesses based off of their goodwill. AE, it's going to be an oil and refining stock. Adams Resources and Energy. It's selling for 74 million. 410 to 316 assets to liabilities. Goodwill and intangibles add 15 into that, so it's 395 to 316. That's a pretty poor margin of safety. Adams Resources. And it actually sells at net tangible book value. AD, we do have retained earnings of 72, but I'm going to guess we don't make enough money. ADNT, sorry, AE revenue over time. Adams. Macrotrends needs to fix their search. Here we go, everybody. If we look at net incomes for the last 12 years, Adams actually posts a profit. And so, as we can see, they carry a lot of assets. It's a very risky business from the asset standpoint. They do a lot of revenue compared to the market cap, but they do generate a net income. It's a very risky business. And then they don't have a great margin of safety. If it were to be liquidated, again, a 25% discount on assets eliminates all equity. I'm going to put that one out solely because of that. But if you were interested in a very, very, very risky cigar, but you could take a look at this one. You'd have to expect a great increase in earnings. on this stock because it's priced to its assets right now. And I don't see a big advantage based off of historical earnings. It's about like 10 to 15 times historical earnings for the last 10 years. So Adams Resources, yeah. AEY, it's only selling for $3 million. Let's see if it's going to zero. Yeah, we'll take a look. We'll give it a chance. Electronics and computer distribution. Let's take a look at their filing. Their latest 10Q. Total assets of 18 million. Total liabilities of 13.7. But almost no retained earnings. I'm gonna guess this business is losing money right now. Yeah, looks like over the last 5 years, last 10 years, they've done nothing but lose money. Whatever's going on out there at AEY, I can't be interested. It's not too cheap compared to its assets or revenues, so I'm out. Next stock, AFBI. It's a bank, AFBI. Affinity Bank shares. Total assets, 855. Total liabilities, 736. See, this is why most banks I'll probably just have to skip on as we go further in the list. They don't have a great margin of safety. That's why banks typically go bankrupt if their assets are worth just a little bit less than what they're reported as. They go bankrupt or they lose all their equity. So I think I might have to start skipping all bank stocks. I can't obviously play in that one. I'm looking for something with a margin of safety based on assets. So next stock, I'm going to be looking at a REIT, AFC Gamma, AFCG, AFCG. Taking a look at the 10Q. AFCG. It's selling for $227 million. It looks like they write the full balance on their balance sheet, which is unique. $445 million in assets, and then 106 in liabilities. And so this is going to be loans held at investment value. But if we look here, guys, we have an accumulated deficit. That's going to be something to look out for if they've never proven that they can make a net income. I'm not looking for that. So right away, let's go to their earnings history. And so you can see last quarter, trailing 4, they're at least reporting net income for whatever reason. Let's see what's going on out here. AFCG. So they're not eliminating shares. They are reporting a net income. AFCG is reporting trailing 12 months of net income at $36 million. Are they stuffing that into their assets? No, their assets have stayed the same. And their liabilities have too. So AFCG... It sells for $227 million, and they earned trailing of 36. So that's not bad, folks. And so, this one will need more research. AFCG, I'm going to leave it at that. REITs are, I think this is a REIT, I believe. I mean, it does have a margin of safety according to what their assets are reported as. I'm not too educated on REITs, but this would need more research. AFCG. I'm going to put that onto my needs more research lists. AFCG. Okay. Next stock is going to be Allied Gaming, AGAE. Allied Gaming and Entertainment. So, 91 million in assets, almost no liabilities. Allied Gaming is selling for 31 million. Very interesting. So they do have a gigantic deficit running. It appears that the deficit is getting worse over time. But without a doubt, these guys really do. I mean, you can see you take their current assets and minus their total liabilities, and we are well above the market cap. So they do have a great asset-based margin of safety. AGAE revenue. Let's see what's going on at this business. So they're almost doing no revenues. Interesting. They're issuing shares. They actually eliminated some shares. AGAE. Huh. Let's see if it fell well below book recently. Yeah, it appears, guys, that if you had bought this stock in 2022, it was in 2022 that it really started to fall off. And it does appear that Allied Gaming is repurchasing shares. Let's take a look. So they bought back $2 million worth of shares in the 9 months ending September 30th, 2023. And they issued a repurchase program on November 11th, 2022. So this one is interesting, guys. I like this. Now, this is an asset play. This is not a business that's making any money. But the fact that they issued repurchases at the time that they did is interesting. And now let's look and see if this business One thing to watch out for is it is a Hong Kong related business, a Chinese connected business. They issued their repurchase on November 2022, in November. Okay. Allied Gaming. That one needs more research. Allied Gaming needs more research, guys. AGAE. AGAE. Agrify Corporation, AGFY. I have a feeling they're going bankrupt. They are. They lost 57 million last year. Their market cap is 2. Skip. That's the quickest skip I've seen so far. Next stock is AGIL, Agile Thought. Agile Thought stock. They lost another one that lost 20 million last quarter, market cap of 4. I'm out. Of Vanguard, AGR. AGR revenue over time. Okay, we've got increasing revenues for AGR. and very solid net income history, trailing at 600 million. Assets of 41. Whoa, that's a lot of assets. 21 in liabilities. I'm skeptical. 20 in equity. Okay, well, let's take a look at AGR through their 10Q. Avangrid's 10Q. Assets. So, wow, we have very little in current assets. Very strange. And then we have a whole bunch of property and equipment, etc., etc. And then 20 million in liabilities. That's very suspicious. If you're going to see a value trap, they're going to be stuffing the numbers into their property and equipment where it can't be challenged. So that's concerning. I wonder if they're repurchasing their stock, they're issuing shares. Vanguard. Okay, and then so we had trailing at AGI stock. It's at 11 billion. See, that's fairly valued. 11 billion is very fairly valued compared to their earnings. And because the assets are so questionable in terms of property and equipment, which is usually the place where they stuff value traps, I'm too sussed out here to, I think I'm out immediately because of those factors. A Vanguard. I'm almost guarantee it's fairly valued. It's at 15 times earnings. 15 times earnings right now. Yeah. We're looking for something that could be at like 4 or 5 times true earnings. So next stock of Vanguard is out. We're going to be at Airgain Incorporated, $27 million market cap, AIRG. And then let's take a look. 46 in assets, but we've got 20 in goodwill and intangibles. So that brings us down to 26 in assets, 10 in liabilities, equity of 16. And so we are now above book value by quite a bit. After taking out intangibles, I'm out. I'm looking for something that is below liquidation value. I'm out. AKA stock. I have a feeling, so 82 million for AKA. $378 in assets, 22 in liabilities for AKA. That's not bad. However, we're going to have 160 million in intangibles. So once we take out that, we're at negative shareholder equity. I am out. There we go, guys. We're done on page 1 of stocks. We're done through the first 20 stocks of 570. On to page 2, AKTS. Yes. Acoustics Therapeutics. $51 million market cap. $51 million market cap. Goodwill of 28. So we're going to be taking 28 out of 67. That makes it 40 in total shareholder equity. And they have a gigantic deficit, everybody, and it's increasing. And it increased by 20 million last year. I am not interested in a deficit at 290 million, no matter what's going on. Skip. ALGS. Oligos Therapeutics. Assets, 85 in assets, 31 in liabilities, total equity of 51, but a giant accumulated deficit of 458 that's getting worse by $60 million over last year. I am out. ALIT Software. Bu- bu- bu. Let's see, 10 billion in assets, 5.8 in liabilities, but we have goodwill and intangibles at 7.2. That's insane. And so we actually have negative shareholder equity after intangibles of $3 billion. I am not interested. I'm looking for an asset-based margin of safety. Next stock, ALPP, Alpine 4 Holdings. Alpine 4 Holdings. Let's take a look at the 10Q, everybody. Assets. We've got 48 million in current assets, total assets, 24 in goodwill, so that makes the total assets at 118. Total liabilities at 82. So 118 to 82 is a very, very weak margin of safety. That means if you liquidated at a 30% discount, you would lose all value. And we also have a giant accumulated deficit on this stock that's getting a lot worse. Alpine 4 Holdings, paid-in capital, and they're only selling for $22 million. That feels fairly valued, very fairly valued. So this is one of those stocks that absolutely deserves to be so far below book value. ALPP, you're gone. Next stock, ALTO, Alto Ingredients. A lot of these stocks below book value are so poor in terms of return on assets that they could never be considered. Alto Ingredients, total assets of 461, make it 450 after goodwill. Total liabilities of 163, that's a great ratio. Their market cap is 169 compared to an equity of 285 or so. That's really good. However, guys, if you look here, we have a giant accumulated deficit yet again. A giant accumulated deficit. So they paid in $1 billion into Alto Ingredients, and now it's selling for $169 million. That's sad. So I could never be interested in a business like that. Alto Ingredients, you're to the curb, son. Next stock, AMPG. AMPG selling for $15.6 million. Let's take a look. 32 million in assets, minus goodwill, make it 27 or so. Total liabilities of 5, 27 to 5 is a great ratio. That leaves us with equity of about 22 million. Amplitech is selling for 15.6, so it's going to be slightly below net tangible book value. We do have an accumulated deficit, which is really, really bad. I don't like that. I want profitable businesses. But we do have a good margin of safety. So this is going to be a business where I can at least look at the revenues to see if there's anything that looks interesting. Last quarter we lost. Quarter before that, 4 trailing quarters, we all lost money. That's not good. Amplitech revenue over time. Okay. Very low revenues, and they lose money consistently. So I'm out. Amplitech, I'm out with the accumulated deficit. Okay, Amplify Energy, AMPY, it's an oil and gas. AMPY, Amplify Energy, filings, assets. Okay, so we have total assets of 717, total liabilities of 371, another accumulated deficit, but it's getting smaller, so that's good since last year. Total liabilities. Let's take a look at their intangibles. No intangibles. It's going to be property and equipment. That's 1/2 of their assets. Amplify Energy. 717 to 371. That's an okay margin of safety. That means if you discounted your assets, you'd have to take them to 50% off to lose all equity. And then obviously that's going to be line dependent. Amplify. Okay, so we have 346 in equity, 245. Let's take a look at the earnings. AMPY. On oil and gas businesses, you're going to have companies that make money relative to gas prices or oil prices. Over the last 12 years, they have lost money. I'm out. I'm looking for a business that generates a net profit, something that I can predict, something that I can understand, not based off of just the latest oil price. And I don't know what's going on looking at the last 10 years of Amplify's earnings. They're not buying back shares. They're actually issuing shares. Yeah, I don't know. Amplify Energy Corp. Out. Next stock is going to be American Shared Hospital Services, AMS, at $15 million. AMS, American Hospital Services. Oh, shit. Sorry. Total assets of 44.5, total liabilities of 18, almost no goodwill. So 44 to 18, total equity of 25. American Hospital Corp, 15. So this is actually a stock that's very cheap compared to its assets. It's possible that this sits below liquidation value, everybody. So American Shared Hospital Services, let's make sure that they're actually, let's see if they're doing any revenue. So trailing, they're about even with a slight net income. Their revenues are very level, so it's not going to be something hard to understand. But over the last 10 years, as you can see, guys, we have actually lost money accumulated. So it's possible that this business serves no purpose to return money back to shareholders. They have not returned any money to shareholders while losing equity. That's not good. That's not good. A lot of businesses will run with the purpose of serving people inside the business without ever generating capital or sending capital back to shareholders. This feels like one of them. American Shared Hospital Services. Just because a business is public does not mean that it has to have the goal of making money. So that one's a skip. AMWL, American Well Corporation. AMWL, we're going to be selling for $388 million. Total assets, 635. Very little liabilities, guys. So this is kind of what we're looking for. Intangibles take our assets down to 500. Liabilities at 115. Equity at 375. Accumulated deficit, though, is getting much bigger. It was at $1 billion last year. It's at 1.7 now. That immediately takes me out. You cannot invest in businesses that lose that much money with the idea that the assets will retain their value. I'm out. American Well Corporation, good luck. It's going out of business. So ANGO, Angiodynamic Incorporated. ANGO. And this stock sells for $271 million. Assets. $493 in assets. And then we have almost no liabilities. That's a great ratio, obviously. 260 in intangibles, though. So if you take the 260 in intangibles out, you're going to have a total equity of 170 on a total deficit of 160. Paid in capital of 603. Okay. So equity of 170 and Angiodynamics sells for 270. That immediately takes me out. I'm looking for something that's below liquidation value or close, guys. I am not interested. AOSL, semiconductor business. Let's take a look. AOSL, Alpha and Omega Semiconductor Unlimited. $622 million market cap. 1.2 billion in assets, 321 in liabilities, a great ratio. Let's see, no intangibles. So we have a paid-in capital of 330 and then retained earnings of 648. So that's a great sign that this business has been built out of retained earnings. Alpha and Omega, it sells for 622 with an equity of 885. Now let's see AOSL. That's a great sign. AOSL. So excluding this really large 383 million net gain in one quarter, which is obviously abnormal, we did achieve a trailing of 60 million. But I'm going to guess this is a growth business. Yeah, it's a growth business with the semiconductor surge. They made 18 in the last semiconductor surge, 2017, 2018. And then back, earnings are very inconsistent, but they're consistent in terms of the fact that the business is profitable. Now, the thing is, guys, they obviously are at a very high multiple relative to earnings. And then they're close in terms of being at book value. That's not the type of business I'm looking for. It's not cheap enough. If this business was half the price, if it was selling for 300 million with earnings like this, instead of 600 million, it would make more sense. But it's already at reported asset values, or almost. And then it's at a very high multiple relative to earnings. This feels fairly valued because I'm going to have my normalized earnings at maybe 30 million if I'm being generous here. If I'm being generous, that's very generous. And even then, that's 20 times earnings. So I'm out on this one, guys. I had to look at it for a second. Outstock, American Outdoor Brands, out. American Outdoor Brands, it sells for 107 million. 239 assets, 53 liabilities. Intangibles take up 50 of our equity. So our equity is 136 after our intangibles. We have an accumulated deficit that's getting worse. So this business has lost money since inception. American Outdoor Brands, a stock. It does have the cigar butt quality of having fallen a lot in price, which could also mean it's just garbage. Losing a 10% margin clip the last 3 quarters, I'm out because of the accumulated deficit and how much money they're losing. I'm looking for something that makes money. American Public Education Incorporated, 102 million APEI. Latest 10Q, 555 to 273 after intangibles. That'll take almost 100 million out. Our equity is 181 for a market cap of 102. We have accumulated deficit that got much worse since last year. So they're probably losing a huge amount of money right now. They are. They did lower the number of shares that they have. American Public Education. Assets over time. Let's see. Let's take a look. So they've increased shareholder equity. But let's see if they issued shares. Not over the last 10 years. They did buy back some shares last quarter. So that's curious that they bought back some shares last quarter. Assets, 559. They could be stuffing a lot of their earnings in their assets based off of looking at that. Now let's look at revenues. So an increase in revenues, but after it looks like a merger. I have to look at that more. Net incomes were very, very consistent. Net incomes were very consistent until a giant write-off. I like this one. This one's fun. If you, what I suspect about this business is that they stuff their earnings into their assets for the eventual write-off. And that's the thing, is American Public Education Corporation looks like a business that makes a lot of money. $171 in equity after intangibles. And then revenue. They were making 20 million, that is until a giant write-off, which means they weren't making any money. Whenever you see a write-off like this, it's very suspicious. So that was 6/30/2020. Let's see. $110. Yeah, here we go. See if I can figure out what. APEI. The market cap is 100 million. They are projecting, the projected losses for 2023. I tried to figure out what their big net loss was for, but I don't know if it matters. So their accumulated comprehensive income, guys, this is going to tell us a lot, is 2 million. And that's over a long period of time. Their additional paid-in capital is 297 million. What I think this business is, what's deceiving is that when you look at their net income record, it looks great for 10 years. But overall, they've actually broke even. And so it's one of these businesses that pretends to make money for 10 years and then stuffs every single one of their losses into a write-off. So I'm not interested. I want to see something that actually retains its value. And so even though it's tempting to put this on the risky cigar butt list, I don't even think it deserves to be on there. So I'm skipping. American Public Education Corp, you're skipped. AQB Farm Products. AQB Aqua Bounty Technologies. Let's take a look. Total assets, 192 million. It's almost all property and equipment. And then their liabilities are 19. Giant accumulated deficit. Shareholder equity of 173. Aqua Bounty Technologies. AQB. Yeah, this is very suspicious because of how they've stuffed every single one of their... They stuffed the whole value of the business into property and equipment. So I'm going to guess this business is going bankrupt. They paid in $400 million. They've lost 212. They're continuing to heavily lose money. Yeah, they had an operating loss on almost no revenue. They had an operating loss. Aqua Bounty Technologies. What is this? Yeah, because of the giant deficit, I'm out. I'm just trying to figure out why the business sells for $6 million when we have equity of 90. But maybe that's for another day. I'm going to guess they're going bankrupt. Yeah, net cash. Okay. They're going, whatever's going on there. You have to understand something to invest in it. I'm out. So next stock is ARC Document Solutions, $120 million. Declining revenues, trailing net income of about 10 million, but overall a loss over the last 10 years. ARC, so it's very fairly valued compared to earnings. I'm just going to pull up the 10Q for whatever's sake. We're going to have some pretty good value in the 10Q. It's fairly valued compared to earnings, 10 times trailing earnings. And approximate earnings averaged out. Yeah, with goodwill taking up 120 million, our actual equity is only 40. So this is well above book value, net tangible book value. I'm out. American Rebel Holdings Incorporated, AREB. So this is a business that's taken heavy losses for whatever reason, AREB. They've issued shares, they're building their business, and their equity just became positive because of shares that they issued. They're going to have a giant loss, AREB. They're going to have a giant deficit without even looking, but let's take a look. Assets. Yep, accumulated deficit of $37 million. That's only getting bigger. Total equity of 13. I can't care about American Rebel Holdings. It's worthless. It's probably going to go bankrupt. ARL, American Realty Investors, ARL. Let's take a quick look at this guy. So it's going to probably be a REIT. Yeah, real estate development, because they're taking profits in big swaths. That's how you can tell it's a real estate business. No decrease on shares outstanding. And they have increased shareholder equity, but have they issued shares to get there? Yes. But let's see here. ARL. I mean, really, this is going to be a business that's probably valued based off of its properties. Let's take a look. Yeah, real estate is going to be the most of this business's value. $8 billion. And then liabilities of 200. Retained earnings of 600, though. That's really good. American Realty Investors. ARL stock. we look, I'm curious to see what has happened to this business's market cap. ARL. So they did sell for 400 million. I'm also curious to see whether this business just fell below book value, or if they've been below book value. Yes. So this business is a business where they invest in real estate. American Realty Investors. So they're going to have revenues from their properties, property expenses, depreciation, and then administration expenses. An advisory fee. They're not buying back any shares, so they haven't bought back any shares over the last 10 years, even though the stock sat so far below book value. That's suspicious. That's suspicious. American Realty Investors. I'm going to put this one on the needs more research list, everybody. ARL. Okay, we'll leave it there on the needs more research list. Arts Manufacturing Company, Art W. Art's Way. Total assets of 25 million. Total liabilities of 13, I mean. That puts our equity at 11. We do have retained earnings of 7.3. Let's see. Our current assets. Art Ways Manufacturing. Trying to find their revenues, guys. So it looks like over the last... Shoot. Trying to find a way to see their assets over time and their revenues over time. My gosh. Sometimes they make it hard on you, don't they? So they have 11 in equity. Art W stock. Let's look at the stock price first. It does have some cigar butt characteristics. It's selling for 10 million. And so with equity of 12 and retained earnings of only 7 over 20 plus years, that's going to be pretty fairly valued. And they didn't show any evidence over the last 12 months that they would generate over $1 million in net income. And they have not. You can see their net income from 2022, 2023, 9 months was only 6 and then 500. So you would have to invest in this expecting net incomes to increase. Let's try one more time to see if we can find revenue. None of these work, I don't believe. None of these. Okay. So here's our net incomes for Arts Manufacturing. We saw a lot of loss. between 2015 and 2020. You see this, guys? A lot of net losses. And so the net income that I saw in the last 2 years, which I thought was small already, was better than before. So I'm out on art. Not profitable enough. Probably fairly valued at 10 million. So next stock is A6 Advan 6 stock, ASIX. ASIX. Advan 6. Let's go to their 10Q for assets, 1.5 billion, 720 in liabilities. Goodwill at 100, that reduces our total equity of 650. Retained earnings are really good, so they have a great ratio between retained earnings and additional paid-in capital, which means this business is very profitable over time. Advan 6 has an equity of 650 million. They are selling for 725, so this is above book value, folks. So the only thing I'm going to look for at this point is an exceptional record of earnings that might blow my socks off, basically. Okay. We can see that they are very profitable, while not necessarily, well, they are increasing their assets. Let's see if they're buying back shares. They are buying back shares. ASIX. Let's get an approximate based off of historical earnings. Let's say 100 million. I mean, last 3 quarters was 100 million. A6 stock, 725. Yeah. Advan 6 has 654 million in shareholder equity, and that's going to be on 1.4 billion in assets, 721 in liabilities. Advan 6, so it's going to be about book value, guys. We're looking for stuff that sells well below book value. So we're going to be skipping Advan 6. Next stock, ASRT. We're going to have to pick up the pace because I'm starting to fall behind the right pace. ASRT, Acerto Holdings, drug manufacturing. It's at 100 million. Let's see, folks. Here we go. Assets. 380 in assets. Intangibles at 180, so they only have 200 in assets. Total liabilities 187. We're out. We can't do that. It's well below net tangible book value. Next, ASUR. Azure Software, $177 million. Let's take a look at the latest 10Q. $160 in goodwill and intangible assets, $230 in assets, $202 in liabilities. That leaves us at $130, while the market cap is $177. So Azure Software, we'll take a look at the earnings history, or let's see, they have an accumulated deficit of $300 million, so I'm going to pass. Atarian Incorporated, $31 million. 10Q coming up. Atarian assets. So intangibles at 54, 102 assets, 54 total liabilities. So that's not bad, everybody. That's not bad. Atarian. But look at this. They have 625 million in deficit. That's horrible. So this business has put in 725 million over time, has lost net 625 million. Horrible. You don't want to buy a business like that because that's a very risky business. The chance that you lose the rest of your money is very high. Skip. Avi, A-U-V-I, it's only selling for 1.5 million. I have a feeling that it has a giant deficit and is going bankrupt. Let's see here. Okay, so Avi, yeah, like I thought they have a very large deficit. They must have lost a lot of money last quarter. Yeah, they're losing $10 million every 9 months. So we ain't going to be touching this one. Their equity is at 17 million, but it's priced to go to nothing, basically. They're priced to go bankrupt, essentially, at a $1.5 million market cap. That's why you're going to want to watch out for stuff that's losing so much money. You're looking for a business that makes money, not this one. Next. AVD, American Vanguard Corporation. AVD. $263 million market cap. Let's get in here. Okay. 210 in intangibles, 600 in tangible assets, 444 in total liabilities. And so that's not a very strong margin of safety at all. Only 200 in equity. Yeah, so this is going to be above book value if it all sold for reported costs, but at very small discounts here, your margin of safety is not that good as well. Well, we do have a great ratio. They only paid in $100,000 to this business, and they're reporting retained earnings of $326 million. And so that's not bad. AVD. And let's see what earnings have looked like. AVD. American Vanguard. So revenues have gone up over time. Net incomes have been pretty positive, actually, folks. AVD. But if you notice, net incomes, let's see if they bought back any shares. They did buy back shares heavily. Holy moly, this is kind of interesting. So they're making the claim that it's undervalued, the business. Revenues have gone up over time, AVD, and net incomes have topped out at 25 million. Now, the market cap is 263 million. Let's look at what happened to the stock. When did they buy back these shares? So they might be paying too much for these shares. If they're buying back stock at above 10 times trailing earnings, that's too expensive. That's way too expensive. And so I think these guys are probably making a mistake here buying back shares. American Vanguard, I think the business is fairly valued. I'm going to skip. So if you know anything about American Vanguard, you probably should criticize the share buybacks. Avanos Medical, AVNS. AVNS. Let's take a look. 1.7 billion in assets, total liabilities 500 million. Oh my goodness, goodwill. This might be the most goodwill I've seen. 1.1 billion. So that actually leaves us with only 100 million in equity. And Avanos sells for 900 million. Not even close, folks. Skip. AVT. Avnet Tech. AVT. Selling for 4 billion. Total assets 11.6 after goodwill subtracted, 8 in liabilities. That's not a great margin of safety. 30% discount on your assets, loses all equity. Retained earnings at 3.5 billion and paid-in capital at 1.7. So that's a good sign. They do have other accumulated comprehensive loss, but not too much in comparison. So they've made money over time. Avnet is a profitable business over time. Avnet selling for 4.3 billion. Yeah, that's unfortunately going to be, unless we have exceptional earnings out there, I'm going to be skipping because we don't have the best margin of safety asset-wise. They do make, let's say they make 800 million. If they make 800 million, then right now we might be sitting at only 5 times earnings. Well, that could change something. Let's see if they're buying back shares. Well, they bought back shares over time. Avnet, how many assets does it take for them to make? So they're getting, all right. They're not getting a great return on assets. Avnet. Feels fairly valued unless, see how net incomes? Shoot. Let's pull it back up. Yeah, I mean, they are selling at a very low multiple relative to earnings. It just doesn't qualify for my rule of it doesn't have a good enough margin of safety. I mean, the earnings look good. That's something someone might like, but I'm looking for something with a deeper asset-based margin of safety than that. That's a good stock, though. Probably market beating. I'd mark that. Avnet. Okay. Aware Incorporated selling for 36 million. AWRE. Aware. Selling for 36 million. Okay, it's 50 in assets. Total liabilities of 12. So that's a good ratio. Equity of 37. Accumulated deficit of 61 million though. So they've lost money over time. So equity is 37. Market cap is 36. So that's going to probably be very fairly valued or even overvalued if they're losing money. So next, AWX. If I remember AWX, it's a golf course that has no intentions of returning capital. AWX. Avalon Holdings. Yeah, Avalon Holdings is a special situation stock where the owners are not returning any capital in over a very long period of time. So if you look at it, it looks cheap. It's 90 in assets. They do have an accumulated deficit, Avalon Holdings. Yeah, they have no intentions of returning capital. I've looked into this stock before. So even though they have a total equity of 36 and it's probably half that, yeah, it's selling, it's even smaller. It's selling for 7. That's because they've shown that it's pretty much a scam to get you to pay money for them to just draw through the business. It's kind of wild that they can do that, but they can. AXR, yeah, don't buy Avalon Holdings. AXR. AMREP. AXR. AMREP Corporation, latest 10Q, 116 to 4. So we're looking at a no debt business here. AMREP sells for 90 million. So if it sells for 90 million and our equity is 112, that could be completely fairly valued. But if you were to put that in combination with a business that, I mean, the one good thing is they have retained earnings of 77 million and paid in capital of 32, so they've made more money than they contributed into the business. That's a profitable business over time. AMREP Corporation, let's look at their revenues, because if there's something exceptional here, that would make it worth it. But as you can see, they took losses or made no income over time, and then only recently took profits. AMREP. Yeah, real estate. That makes sense that they would take profits in the last couple years. Based off of the last 15 years worth of earnings, and then let's look at shareholder equity. AMREP. Pretty much flat in terms of shareholder equity, folks, over the last 10 years. That's a business that's not making any money. So it's going to be fairly valued right there, about 90 million, probably even less than that. It's going to be the value of the real estate, just the value of the balance sheet. So AXTI, and this is going to be our last stock in the A's. AXTI, what is this? Semiconductor equipment and materials. $342 to 74. That's a great ratio. 342 to 74. Total equity. So they have a deficit. They've lost money over time, but total equity, or most likely, total equity 204. AXT is selling for 89. Okay, so that could be something. That could be something. They are losing money. AXT. So they lost a massive amount of money. Something is wrong with AXT's business. AXT revenue over time. This business is scaring me. Yeah, revenues went down 100%. 100%. So very inconsistent net incomes. They sway greatly. Average net income over the last 10 years, probably 3 or 4 million a year. And so if it's selling for 89 million, we're looking at it. Okay, here's what we're looking at. We're looking at a business that is probably at 20 plus times normalized earnings right now, which is very expensive. But in terms of assets, we've got assets that are worth something. So it's in that delicate balance, but it's got an accumulated deficit, losing money as of recently. I'm looking for businesses that are profitable over time. I am. So I'm going to be skipping out on this one. But from the asset standpoint, it's worth it if it were just to liquidate, but that you never know if that's going to happen. You have to go do that yourself. So in that respect, pass. Barnes Group, B stock. B. $1.3 billion. We got goodwill taken up, oh gosh, intangibles taken up 1.8 billion. We've got 1.6 billion in true net assets. That wipes all of our equity, guys. We're on the next one. Bay First Financial Corp, BAFN. This is another. It's going to look like a bank's balance sheet. So I'm probably going to be out very quickly based off of how many assets they have compared to liabilities. Let's take a look. Yeah, you see how it's an 11 to 10 ratio, assets to liabilities. Banks are fundamentally a little bit too risky. I might start skipping them. Bark Incorporated Consumer Cyclical Retail, BARK. Bark Incorporated. Let's take a look. Assets. Intangibles, almost none. Negligible. 386 to 218. That's an okay ratio. Current ratio looks good. 286 to 85. Total shareholder equity of 150, but a giant accumulated deficit. Oh my gosh. We're not looking for this crap, guys. Giant accumulated deficit. $331 million, getting bigger. I don't want that. They're losing too much money. Bark, gone. BCAL, Southern California Bank Corp. Oh, I think they went out of business. We'll do it this way. Trying to find macro trends. Yikes, sorry guys. Getting us caught up. It's hard to navigate. Here we go. Assets 2.3, liabilities 2.0. Yeah. I don't even know why I'm looking at the banks, but let's look at the banks. Let's look and see if there's just something that sticks out net income wise. They don't even have the stats here. I'm going to skip it. Flanagan's Enterprises, restaurants, $50 million. It's BDL stock. BDL. I'm gonna have to heat the pace up, guys. I'm only like halfway or a tenth of the way done with our whole search. 146 in assets for BDL, 70 in liabilities. They do have great retained earnings. They've made the business out of their retained earnings, so good for them. And total current liabilities. What's the current market cap for BDL? 50 million. So let's look at, this is interesting. They're below net tangible book value. They built the business with their earnings. BDL revenue over time and income over time, BDL. Here we go. Oh, so this business is growing consistently, growing their revenues. Oh, and then also growing their net incomes pretty solidly as well. BDL. Flanagan's. Interesting. So do they possibly have any share buybacks? Assets. They're not getting the best return on assets. And what I mean by that is right now, their assets, 146. Their net incomes are going to be 6 on 146. That's not the best. But if they're generating that net income, yeah, do they pay a dividend? I wonder if they pay a dividend. They do pay a small dividend. Flanagan's. I think Flanagan's is worth being watched. I mean, I'll say this, if Flanagan's was about half the price, or even at 30 million instead of 50 million, I'd be interested. I just think it's probably more fairly valued here at 50 million because of the low return on assets, even though it's profitable. I'd say Flanagan's is, if it's probably worth 70 million. And so if it went down to 30, I would be interested. So BDL. Yeah, BDL. Let's put this. Let's put this on our stocks to watch. Okay. Next, BurgerFi, $33 million, BFI. Dun, 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 dun. $263 in assets, 196 in liabilities. That's a horrible ratio. In fact, with intangibles, our equity is completely wiped out. We're out, guys. We're not going to waste my time. BFIN Banks. BFIN. Bank Financial Corporation. 1.5 to 1.4. I mean, really on these banks, guys, we're going to be looking at earnings more than anything. Bank Financial. And it's just too risky. 1.5 to 1.4 is way too risky of a margin of safety. I'm just outright there. I don't even care. I might not look at more banks. I keep saying that. BFLY. Butterfly Network. $334 to 77. That's a great ratio. Total shareholder equity of 257, but a giant deficit of $685 million. I'm not interested in a business with a deficit like that. Butterfly Network. Especially if they're losing money. Yeah, they lost 27 million last quarter. That's a joke. Next. Bowflex. Oh, the biggest joke. I've seen Bowflex before. We'll take a look at it, though. No filings. Yeah, Bowflex is going out of business. I'm not even going to look at it. But they had a huge surge during COVID where people bought it. And then I think they bought back shares for a second. But then since COVID, they've lost a giant amount of money and they're going out of business. So next page, Biglari Holdings, BH. $450 million. $750 in assets, $270 in liabilities. $500 in equity. $500 in equity with a $450 million market cap. I would need to see exceptional earnings. I think it's an investment conglomerate. It's a restaurant holding business. Okay. Biglari Holdings. I'm going to guess it's fairly valued, but I can't really tell. I'm just not going to be interested due to how weak the asset-based margin of safety is here. Now, there might be some hidden information that makes this really undervalued in the earnings perspective, but it doesn't compare to the best things I've found asset-wise, not even close. So I wish I had more time for that one. I'm going to skip. BHB. We've got another bank that's got a very aggressive asset to liability ratio. Too much so for me to care. I mean, banks are really all about what the assets and liabilities are, and honestly, I don't care enough to probably hit any more banks on the rest of this search. Next stock, BHE Electronic Components, $900 million market cap, Benchmark Electronics. Let's see. BHE, 2.3 billion. To 1.3. Goodwill takes up 200. So the actual equity is 860. We again said that's going to be below our market cap, so it's above reported book value, net tangible book value. Yeah. It's just going to be too fairly valued asset-wise. I'm looking for stuff that's below liquidation value, so I'm skipping. BHF, Bright House Financial. BHF. I'm going to be... So they've lost money over the last 8 years. I'm going to guess they have 230 billion in assets and then 226 in liabilities. I'm going to stay away from that one. That sounds risky. To say the least. To say the least. BIMI, B-I-M-I. Revenues have been... They're low at only 12 million. BIMI Medical. So it sells for 5 million. This could be a little tiny cigar butt. Net incomes, oh, they've lost money consistently over time. Sad. Yeah, and it's just below book value. I mean, it could be below cash or something, but they're losing too much money for it to matter. Let's see if there was a point at which you could have bought this something that where it looked like it had a good margin of safety. Curious. Kind of looks like they never... Did they ever buy back shares or anything? No, it doesn't say. Oh, well, it's not worth it. BIMI, gone. Allbirds Incorporated, Bird Stock... All right. We got 380, no intangibles, good amount of currents, great current ratio, very little liabilities compared to the market, compared to the assets, good ratio there. Dang, then a giant accumulated deficit. Wonderful. It ruined the whole balance sheet. So this business just loses tons of money. Hand over fist. I'll pass. Allbirds is a pass. BKYI. BioKey. Sells for only $1 million. I'm going to guess they lose a lot of money. Yeah, sad. So they lost a trailing $11 million. It sells for $1 million. They're going bankrupt, folks. Bridgeline Digital, BLIN, it sells for $7 million. Bridgeline Digital. 25. So the goodwill, look at this. Goodwill is 16 of the 25. So that makes it about 9. Total liabilities 7. So we have $2 million in equity. And it sells for 7. And a giant accumulated deficit. My goodness. They started this business with $100 million and they lost 81. Wonderful. Wonderful. Ridgeline Digital. Good luck. We're going to skip the bank. Well, actually, we'll take a look at it. BMRC. I guess what we'll do is on the banks, guys, we're going to look for ones that stick out statistically compared to other banks. So 4 to 3.6. Yeah, I've seen banks before that have much more exceptional ratios than that. Retained earnings. Okay. I mean, the thing about banks is they can manipulate their assets so much so that it's hard to ever pin down a margin of safety on one of them. So I can't be in on such a highly leveraged business. BMTX, 28 million. BMTX, 28 million. $57, make it 54, make it 50 after the intangibles are taken out. 50 to 20 ratio, 30 in equity. Deficit though, so they've lost money over time. And it's accelerated 8 million between 2022 and 2023. You can see right here. Losing way too much money, lost $4 million, 9 million trailing 6 months. So with equity of 30, what's it selling for? 28, fairly valued. Next stock, BNGO. So 180 million in assets, 62 in liabilities, 37 is going to be intangibles, 40 or so. So 145 we'll say to 60. 145 to 60 means 85 in equity. And it sells for 52. But they have a giant accumulated deficit yet again, folks. The evil giant accumulated deficit strikes again. So with that much of a deficit, I cannot invest in a stock losing that much money. Gano. Beachbody Company, BODY. Selling for 48 million. 347. Make it 200 after intangibles. So after intangibles, there's no equity. I'm out, guys. BOLT. Bolt Biotherapeutics, $36 million. 175, 1 to 47, make it 128, and it's selling for 35. But they have a giant deficit yet again. So they're losing so much money that they're priced out of their entire shareholder equity. And I'm not surprised. When you've lost, looks like they've lost 50 million between 2022 and 2023. Man, that's a business going straight to bankruptcy. There's nothing they're going to be able to do to return that equity. Bolt Biotherapeutics, good luck, you're going bankrupt. DMC Global, boom stock. Okay. Oil and gas. Sells for $313. Okay, so 340. It's gonna be about 550 after intangibles. 550 to 303. 550 to 303, so about 250 after the intangibles are taken out, and it sells over that at 313, so it's above book value. And very low retained earnings. Let's look at their latest net income. It is pretty cheap, but I'm looking for something with a deep asset-based margin of safety. DMC Global. Yeah, it looks pretty fairly valued. It's going to be about 10 times earnings and then 1.2 times net tangible book value. That feels fairly valued. I'm skipping the banks, guys. And actually, this one's at 5.3 times earnings. We'll take a look at this one. BOTJ. So we have a quickly growing bank in terms of revenue. The net income, trailing net income is 8 million going back to 2021. 948 to 8. Okay, so they have that normal 20 sort of ratio, 20 to 1. Bank of the James is very cheap relative to other banks in terms of earnings. BOTG recent earnings are very cheap. BOTJ. But that could be manipulated. That could be manipulated. So BOTJ is cheap. Now, I'm saying compared to other banks, BOTJ is cheap. Yeah. But I'm going to have to skip anyway. Okay. BOXL, $10 million. Boxlight Corporation, $10 million. 130 in tangible assets. Yeah, so only 10 in equity. See, it's 130 to 120. Yeah, and it's also losing money, accumulated deficit getting greater and very rapidly. This is a trash stock. We're going to skip the banks starting right now. Bridgeport Foods Corporation, BRID. Selling for $90 million. $128 in shareholder equity and retained earnings. They built the whole business out of earnings, which is great. This is a very profitable business. Bridgeport Food Corporation, $128 million in equity. Let's go to macro trends to see earnings a little better. Bridgeport food revenue. So their earnings are not great. They're not getting a great return on assets. Yeah. Now they have a good margin of safety. So if they liquidated right now, they might get back the market cap. And they've built the business. This is a good business. I mean, it's a good business. That's for sure. But is it cheap enough? Unfortunately, no. It's not cheap enough. Yeah, it's not cheap enough. If it was cheaper, let's look at the price history. Yeah, if Bridgeport Foods went down another 50%, call me up. If Bridgeport Foods goes down another 50%, BRID. I wish I had a not cheap enough list. Okay. So I'll put it on ones that are not cheap enough. It's not cheap enough. So Bridgeport, yeah. Berry Corporation, BRY. $1.6 in assets, 900 in liabilities. They have a deficit, they've lost money. Total shareholder equity of 700, priced at 500 is probably fair, and I'm gonna guess they're not profitable. So without even looking, and their profits are gonna be based off of the price of oil. I'm not looking for something like that, so I'm gonna pass. And then, because I'm speeding up, I'm skipping Banks, Pagoda, Financial Corp. You're skipped, bro. Next stock is Bassett Furniture Industries, BSET. $10Q. All right, total 369 total assets. Goodwill at only 21, so that's going to make it 360, 348, 348 with an equity of 188, 160 or so in liabilities. I don't give the total. They do have good retained earnings. They lost some money between 2022 and 2021. Total equity of 188. Bassett selling for 143. The equity gets reduced by goodwill by 21. So that equity is down to 167, 143. That's not a very cheap stock. BSET. Bassett Furniture revenue. They're very profitable. And then excluding this one giant quarter of earnings, I think we're going to be looking at, that one's 47, so 13 to 15 at most in earnings, 13 to 15. And then it sells for 143. If that's earnings at most, then it's definitely going to be fair priced here at 143 or about fair priced. So I'm going to pass. Bit mining Ltd, BTCM. Dun, 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 dun. 31 million. Oh, I remember this business. It's crypto assets. I'm skipping. Bit Origin. That feels like another crypto. BTOG. Bit Origin. Assets 35 million to 0. We're gonna have to find these SEC filings. Because for some reason, they're not. Is this stock even active? Looks like this stock went all the way down from... Oh, looks like they lost 12 million last quarter. And then all last 4 quarters too. So BTOG is going to be a skip, guys. I have no idea what's going on besides that giant loss, and that's enough to skip. Better Choice Company, BTTR. BTTR. I'm going to guess Better Choice is losing a lot of money. $7.7 million market cap. Close these other tabs on us. Giant accumulated deficit, I guarantee. Yeah, look at that. So the market cap is 7 million and the deficit is 300 million. That's a business that's going bankrupt. Better Choice. Peabody Energy Corporation, 3.12 billion. BTU. Peabody Energy Corporation. I'm going to guess it's fairly valued based off of earnings. 5.7 in assets, 2.2, 3.5 in equity, and it sells for 3.12. So it needs exceptional earnings. And since it's a coal stock, it's going to be profiting based off of the price of coal. It's going to see a surge back in 2021 and 2022. But as you can see, overall loss over time. And they also have very little retained earnings. They have not made much over a long time period out. Next business is BV, Brightview Holdings. All right. Okay, this one's weird. This is a weird 10Q. This is a weird 10Q. I don't know where I'm going on this 10Q. It might be a prospectus or a prospect or whatever they call that. I'm looking at Brightview Holdings, BV stock. Okay, it sells for 672 million. Brightview Holdings. Let's try to go to macro trends and look this up. Growing revenues. Oh, okay, so their average net incomes are not great. Brightview, if it's selling for 672, yeah, they don't. So it's at a giant multiple relative to historical earnings back to 2018. And then assets, 3.2. Yeah, I'm going to guess there's a lot of liability here. To 2, yeah, it's not a great margin of safety. So it takes a lot of assets to make a very little amount of money. And they don't, it's probably overpriced at 600 million. at probably what, 20, 30 times earnings. It's got to be worth less than that. So it's a crap load of assets worth nothing. BV, skip. Next stock is going to be this bank. We'll do a bank. See, that last one was an example of a not so leveraged bank. Yeah, again, I'm not going to do the highly leveraged banks. Skip it. Okay, so now we're on to Broadwind Incorporated, BWEN. Selling for $50 million. Come on, baby. Give me a good one. 164, 162 minus after intangibles. Equity at 54, deficit at 342. That's a crapper. Next. BWFG. We're going to skip these banks. Skipping the banks. BZH, Beazer Homes USA. What you got to watch out for with these home builders are inflated profits, basically. Their profits recently are not going to be their profits forever. We've seen one of the biggest surges in home building profits ever in the last 3 years. So they've got equity of 1. I'm just going to go to... I'm going to go there. Thank you. Thank you. Their filings. Oh, geez. There's only a 10K, not a 10Q. Oh, never mind. It's the same thing. Sorry. Equity of $1 billion. Selling for $851. But the value of the real estate is at an all-time high, so you can't expect their earnings to continue. Like, they don't have very many in retained earnings. Look at this, 852, 62 in paid-in capital, 182 in retained earnings. So that's very low, very bad ratio for how long they've been in business. It's not very profitable. It's pretty fairly valued. I'm out. BZH. So now we're on to the C's. Cara Therapeutics, CARA. Biotechnology, $60 million. 115 in assets. Oh my gosh, giant deficit, guys. Look they lost 80 million last year. That's gross. That's a lot of the therapeutic businesses for some reason. Skipping banks. We're now on to Cato Corp, and I actually marked Cato Corp as a stock to watch recently. So let's take a look at this one. Cato. Selling for $140 million. So, no intangibles. The right of use assets are 130 both on the assets and the liabilities. The equity is 225. But that's going to be coming from like 370 to 150. It's going to be 370 to 150 tangible assets minus lease liabilities, lease assets to total liabilities minus lease liabilities. That's a pretty good ratio, giving us an equity of 225. Retained earnings are okay. It's been around, Cato's been around a long time, so they should have more retained earnings than that. There's something wrong with the business. Like they're losing money in certain time periods, if that's true. If they've been around since 1987 and they only have retained earnings like that in comparison to the market cap, I noticed that Cato is eliminating shares. Yeah, their shares outstanding is going down. So management might think it's cheap. Does have an okay asset-based margin of safety at 140 million with 220 in equity. But it appears that their net incomes have really gone down. And since about 2017, they haven't trailed above a 35 in net income. I mean, but even then, that's really good. They did get up to 33 trailing net income, and they're barely profitable right now. See, I think if you believe in a turnaround with Cato Corporation, it's very interesting. I'm going to put this... I think I'm going to put this... I had a hard time deciding. Needs more research. Yeah, I would say needs a little bit more research. Cato. We'll put it there for now. So, Cato Corporation, that's that. Next stock is CBFV. Oh, that's a bank. We're skipping. We're going to go to C4 Therapeutics, CCCC. Another therapeutics with giant accumulated deficits. 493 million. I'm out. CCLD. CCLD. Oh, Lord. Oh, no. 125 in assets. 33 in liabilities. That's good. But we do have a deficit, a running deficit, and a worsening deficit. So they're losing money. 88 in equity. CCLD. Yeah. Yeah. I mean, it's very cheap. It really plummeted. Let's look at CCLD over time. They always lost money. So CCLD is always lost money. That's why it's priced so low. That makes sense. So I got to prove that your business can make money. Skipping the bank, and then now we're on to CCS. CCS stock. Century City Communities, another home builder, 3.9 in assets, 1.6 in liabilities for 2.2 to 2.3. They've built the business out of retained earnings, which is great. And then what's the market cap? Yeah, it's fairly valued compared to assets. Yeah, just barely below reported book value. That's why it showed up on my screener. And then, yeah, as we see, they went through the big bubble of earnings, and now it's probably going to be much more fairly valued compared to normalized earnings. So, yeah, 2.3 billion, I can't be interested. It needs to be half that price. Looking at CCLD, guys. Or actually, we just finished CCS. I'm back at it. Let's go to CDE, Kiwuru Mining. It's a gold business. CDE. I'm going to be getting right into this. CDE. Let's make sure the right one came up. Kiwuru Mining. Okay, 2 billion in assets, mostly property though, and equipment, as we talked about. That's a value trap in most situations when it's equipment. Total liabilities of about $1 billion, so it's a 2-to-1 ratio, and the market cap is 964. So this is barely below book value, guys. This is not going to be worth it unless, you know, I know it's not going to be worth it. I don't even have to look. Accumulated deficit of $3 billion. So this business, everybody, this business started with 4.1 or put in $4.1 billion at various points over time, and they've lost a net of $3 billion. That's incredible. That's horrible. No wonder the market cap is so low. Probably overvalued at 964 million. I'm skipping. Seeds, CEAD. It's selling for almost nothing. I'm gonna guess there's a giant loss on this one too. Yeah, it's selling for $4 million. I guess there's a giant deficit. The accumulated deficit of 36 million. I'm out already. CELU. I'm gonna guess, and yet again we've got a deficit here. Okay, not as bad. Oh yeah, no, it is bad. It is bad. 770 million deficit. Cellularity Incorporation. I'm immediately out on that. I'm going faster if you haven't noticed, folks. And then also, I'm skipping all of these banks. We talked about this. I'm not going to be messing around with banks because none of them have a very good margin of safety in terms of assets. They're too risky. Software, we're all the way down to CISO, CISO. CISO Global. 56 in assets, but that's mainly goodwill. So that's 20 million in assets, 31 in liabilities. I'm out. Accumulated deficit of 100 and ridiculous amount of $1 million. That's insanity. CISO is in trouble. CLAR, CLAR. It's selling for $200 million. Let's take a look. Total assets 500 minus goodwill. And I'm gonna minus these intangibles, 240 taken off. That's 360 over 205. That's 160 equity. 160 Claris. And what was the market cap again? 198, so that's over net tangible book value. I'm not really looking for that. Claris, and then a giant deficit. Good Lord, man. Next stock, We're looking at CLDT, real estate stock. CLDT. Okay, let's see. CLDT selling for 498 million. If you look here, okay, they actually have a lot of money in hotel properties. That's most of their assets. And then we have total debt of 548 million. So a very good debt to equity ratio compared to other REITs. Total equity of 817, that's going to be net tangible equity. Chatham Trust, selling for 500. But here's the thing, we have an accumulated deficit. CLDT, how long have we been around to accumulate a deficit? 2010 at least. Oh, so it was founded in 2009. So from 2009 to now, we've accumulated a deficit of $257 million. Total equity of 800. This is a business that doesn't make any money. But let's see if they're growing revenues over time. No. Yeah, it's not worth it. CLDT is out. Way overpriced. Good Lord. Really, the assets are the only thing keeping that price up. CLRO, Clear One. Okay, it's selling for $17 million. Let's take a look at Clear One. So Clear One holds a deficit of $4 million. See, I've looked at this one before. Assets of 47 after the intangible, 47 to 7. So assets to liabilities is 47 to 7. Interesting. Clear One. And I believe Clear One, this one's very funky, guys. We might have to mark this one. So revenues have been decreasing a lot. They really don't profit at all in total over the last 10 years. That's why we don't have any accumulation. So it's a business that doesn't make any money. We're looking at a business that doesn't make any money, but do they return? They're issuing shares? Ew. CLRO, does it pay a dividend? To be honest, based off of looking at the graph and how the price has been, how the stock has been priced in the past, it does have some cigar butt tendencies. But since it was, think about this, guys. This business has been around since 1989, and we have a deficit, a running deficit over that time. And if they haven't returned any capital in 30 years, and there's a running deficit, it doesn't matter per se that your assets are sitting there at 1/3 of what the market cap is, because that appears to be what's going on. So does Clear One have any history of returning equity is the question. And it doesn't look like it. They haven't returned any money in the last 10 years to shareholders. Haven't made any money or returning. It's just a sitting pile of money. That's interesting. It's just a sitting pile of money. CLRO. I think this one will get lucky, and I will put this one... I gotta be quicker here. CLRO. This feels like one of those stocks that has no intentions of making money. As weird as that sounds. They have no intentions, like they only operate with the goal of serving the people inside the business. I'm skipping clear one. That's a tough one, clear one. So I'm going to put two stocks on our weird stock list. CLRO and then Avalon. And we'll talk about that later. Okay, so CLRO, that took a little while. Let's move on. CLSK. CLSK sells for 600 million. Let's take a look at the 10Q. 652 in assets and no liabilities. Goodwill takes up a very small portion, only 640. Still 640 total to no liabilities. But it's almost selling at book value. Yeah, it's selling right at net tangible book value. So it's all going to be about earnings. And so no gain or loss in shareholder equity over the last 10 years. You can see it right away with the revenue going down. Oh, this is the wrong stock. Sorry, folks. Clean Spark, CLSK. Clean Spark. Ooh, revenues have gone up. Is it possible we're looking at a business? Well, okay, so they're going to have a large deficit. Accumulated deficit of 257 million. This is a business that's really draining a lot of money right now, Clean Spark. So even though it's selling at net tangible book, it's probably actually overvalued. It should be priced below what it's priced at 600 million if it's losing this much money. Last year it sold 60 million. You can tell between 2020 and 2023, the deficit got that much bigger, whatever that was. So I'm out. CLW, Clearwater Paper Corp. CLW. Selling in the 500 million range. Selling at 600 million. $600 million. Okay. No goodwill on here, but a lot of the assets are in property and equipment, which is always a red flag. We've got just as much equity as the market cap with a very weak margin of safety, 1.7 to 1 ratio. So any discounts take away from our equity in a liquidation. It's not even close to liquidation value in most scenarios. They have reduced shares slightly, so I would look into that if I was looking at this stock. Earnings are positive. Well, here's a great thing about this stock. This is wonderful. The fact that they have built the business off of retained earnings is great. That means it's a very profitable business. So Clearwater Paper Corporation is very profitable. So let's take a look at their profitability and see how well they do, because it could be at an exceptional discount. So let's take the 12-month trailing. If it's 60 million, then it's fairly valued right now, assuming no revenue growth. Yeah, no real revenue growth. So this stock is going to be fairly valued right now, right around 600 million, probably a little overvalued. Skip. Clearwater, CMAX, CareMax Incorporated, CMAX. Okay. CareMax Incorporated, what's it selling for? 106 million. So monster goodwill on here, 522 million in goodwill makes that our total assets only 500, and then actually 400 after other intangibles. Total debt is 533. I'm out immediately. I will not buy something that's negative net debt. Next. CMBM. Selling for about $100 million. CMBM. Selling for about $100 million. Goodwill is only 10, so 259 over 124. 145 is our equity. We have, sadly, we only have a break-even business over time, unless there have been dividends. Cambium Network stock, let's take a look at the stock. Looks like we had a surge. Oh, lost 26 million last quarter. That could be a write-off. Okay. Well, let's take, I'm going to be curious to see CMBM revenue over time. CMBM net income. Well, it looks good, but we have a clue in our balance sheet, and that is that there is we've been break even over time. Accumulated earnings of only 12 million over the course of the business. Cambium Networks. I'm going to see when the business was founded. It was founded in 2011. So since 2011, we have only made $13 million. That means we're pretty much not making any money. And so Cambium Networks revenue over time, very, very small increases. It's not a giant growth business. I'm not impressed. It's probably, since it's right there, just below net tangible book value, but with those horrible crapper earnings, I'm going to guess it's actually overvalued, Cambium Networks. CMTL. Comtech Communications Network. $350 million. We're gonna get in here. Come on, baby. I hate when I have to get into the 10K. There we go. Total assets of, so we have goodwill taking up 550 million of these assets. That makes the total assets only 450 million net. Total liabilities is about the same. I'm out immediately. Next. Cannae Holdings, CNNE. Restaurants, $1.2 billion market cap. Cannae Holdings, let's take a look. Cannae Holdings, $2.7 billion in assets, almost no liabilities. That's a great sign. We only have a little bit of goodwill in there. So 2.7 billion in assets, almost no liabilities. And what was the market cap again? 1.27 market cap. So that's interesting, everybody. Investment in unconsolidated affiliates is most of the assets. That's not a good sign. I mean, that could be a good sign, but it's not a good sign that all of the value is hinged on one thing. Investments in unconsolidated affiliates. Okay. So let's see if this business has a deficit. Yeah, so they've just about broke even over time. Oh, retained earnings of 1 billion. So this business has made as much as the market cap over time. This is interesting, guys. Cannae Holdings revenue, and that's only, this could be a conglomerate sort of situation where they report profits. I'm very curious to see at certain times. Okay. Cannae Holdings. Whoa. Now, shareholder equity-wise, see stock. Let's see what happened. Has the stock fallen recently? Oh. So Cannae Holdings. Let's take a look at this. So they hold restaurants. Interesting. Cannae Holdings. Interesting. I'm curious because in the past, we've seen many stretches from this business where they've reported a lot of income. Now, recently, it looks like they've lost a lot of money, but I'd be very curious to understand why. I think, let's see if they bought back shares. Ooh, they have bought back shares. Folks, this is interesting. CNNE. So whenever you see a business that bought back 10% of their shares, that's a good sign. That's a good sign, whatever they're doing. So CNNE, and they thought the stock started to get cheap at what, the start of 2022? Yes, they did. So CNNE, folks, we may have found a nice little stock here. Whoa. Now let's actually, I'm going to take a look here. Price ratios, price to book. It's probably been sitting really well below price to book. Whoa, guys, CNNE. Someone needs to look into this stock. CNNE. Stocks to watch. CNNE. Okay, that's written down on more information needed for sure. So last stock on this page is CNVS at $13 million. Cineverse, shoot. CNVS. I'm gonna have to look this one. I'm gonna have to look it up manually. CNVS, Cineverse, SEC filings right here. Let's try to get these 10 Qs right here. Here we go. 82 in assets, 38 in liabilities, but goodwill and intangibles take up 40. That means our equity is at 5. That means we're out. Guys, next page. CNX, Oil and Gas Corporation. So CNX Resources Corporation, total assets 8.2. Goodwill is only 300 million of that. 8.1. Total liabilities. So shareholder equity is going to be 3.6 or so billion. 3.6 billion in shareholder equity, net shareholder equity, and it sells for 3.4. So that makes sense. CNX. And now let's look at their earnings. Revenue over time. Yeah, very poor earnings overall. And I'm going to guess that CNX, okay, they do have retained earnings of 1.5 billion over time, which is okay compared to pay in capital. But over how long of a period is that? And they don't pay dividends, it appears. So it's been a long time, and they've only gotten a 50% return on equity over a long period of time. This is a pretty poor business. Completely fairly valued, probably overvalued at right about net tangible book value. So next stock, COF, Capital One. Well, I know it's probably not going to be too inefficiently priced because it's so big, $40 billion market cap. But let's take a look, because I actually remember Warren Buffett bought this somewhat recently. Berkshire did. It could have been Ted or Todd. So COF, we'll take a look. We'll have some fun. Oh no. Deficit. This is not the right. There we go. Might have to dig a little bit here. Okay, so we have assets of 466 billion at Capital One and liabilities at 411 billion. So Warren Buffett or Ted or Todd, whoever it was making a play on earnings for Capital One. Let's see what Capital One's market cap. COF market cap. Actually, I know which site to go for this. Sorry. Here we go, COF. I'm curious to see the market cap for the last little bit. So it was between 30 and 40 million. I'm just investigating at this point to see what Ted or Todd was doing. Yeah, so they're buying at what they thought was could be 5 to 10 times earnings. 5 to 10 times earnings. It was an earnings play into Capital One. An interesting one, I like that. But nothing I would ever buy with a small sum. I'm gonna close some of these tabs. Let's move on to CPE, Callan Petroleum. CPE. And what's our market cap? 2.25. $6.7 to 2.7 with an accumulated deficit over time, so they've lost money. But we do have equity of 3.8. Callan Petroleum. Only income as of recently. See if they've done any work on shares. They've issued shares. Yeah. I mean, that's fine, but not for what I'm really looking for. And as you can see, shareholder equity, I mean, if they liquidated, it might be below liquidation, but I'm also looking for a profitable business that's at a very low multiple to earnings, and this is not. This is a business that doesn't make any money. And so, next stock, CPIX. Cumberland Pharmaceutical. Cumberland Pharmaceuticals, CPIX, selling for $23.8 million. They have 60 in assets after intangibles taken out, and then 52 in liabilities. That's only an equity of 8, folks. And then they have a moderate deficit of $11 million since the start of the business. Cumberland Pharmaceuticals, when did the business start? 1999. They have a deficit since 1999. I'm out. Computer Programs and Systems, CPSI. Let's take a look. Assets. Ooh, 200 million in goodwill takes away most of our asset value. It's actually 290. Wow. That leaves us with 130 in assets. That leaves us with negative shareholder equity after goodwill is taken out. We are not looking for that. We're looking for a margin of safety with assets. CREX. Creative Realities. Selling for $20 million. Total assets, about 40 after goodwill. Total liabilities, 42. We're out. Next stock, CRNC. Cerence. We have, oh my gosh, 900 million of the 1.3 billion is it goodwill? What? So we have negative equity here? Goodness gracious. Goodness gracious. Let's see, Crown Craft, CRWS. I actually know about this stock. Let's look at Crown Craft. It's It's one of those funky ones that might have a deficit, but they've been making money recently. Let's see. La-da-dee, la-da-doo. Yeah, so Crown Craft has 87 in assets, 80 in assets, 30 in liabilities. Sorry, 36 in liabilities. 36. And then shareholder equity of 42 after the goodwill. Yeah, and so it's at book, it's above book value, it's above net tangible book value. So I believe Crown Craft had come up because it was at a low multiple to earnings. But yeah, above net tangible book value doesn't cut it for me. Skip CSTR, we're skipping that because it's a bank. Charles and Culver, CTHR. Total assets of 46 million with almost no goodwill. And then total liabilities of 9. So 46 to 9, Charles Culver. And the market cap is 12. But we have a giant accumulated deficit. Yeah. That's going to mean they're losing a lot of money. And I'm not going to be interested because of that, because this business is going to be going straight to bankruptcy. Wow, this business is absolutely, wow, this business is losing hand over fist. 2.5 million last quarter alone on only 4.9 million in sales. That is a disaster. That is a disaster, Charles and Culver. Something's going on with that business. It's not good. CTM Castellum Corporation. We're going to be looking at a $10 million stock. I'm going to guess they're losing money and going bankrupt. Oh no. So they have 20 in assets after goodwill and then 17 in liabilities. That means I'm out. Next stock is CTV. It's an advertising agency selling for 180 million. 245, but goodwill and the intangibles are going to be 130 of that. So that leaves us with 115 in assets, total liabilities of 55. That means our net tangible is going to be about 65. Accumulated deficit of 180 million. That means we've got a disaster here. Disaster. Not even close. Wow, that is way overpriced. CTV, you are in trouble. CTV is in some serious trouble. Good luck. Well, we're going to skip the bank, and then now we're on to Culp Corporation, Culp Incorporated, selling for 64 million. Culp stock. And latest 10Q, we are looking at almost no intangible assets. This is going to be currents plus property and equipment, so that looks good. 142. Total liabilities of 56. I like that. I like that. Shareholder equity of 86 with accumulated earnings of 40. This all looks mighty fine. That all looks okay. So we have shareholder equity of 86, accumulated earnings What is the market cap? 64, so it's not that discounted. But let's go to macro and then look at our incomes over time. Are we making money? Income or revenues are kind of flat. We were making money. We were. So Culp made a pretty consistent net income, about 20 million up until about COVID. Then right before COVID, we had struggles too. Didn't recover and now is losing. At any point, did we buy back shares? We did at some point. Yeah, shoot. Culp. 140. Wasn't it barely undervalued? Yeah. You're going to have to believe in a turnaround here with Culp. And then we have retained earnings of 40 million. But that's down quite a bit from 70 the year before. So there was a massive loss. Culp stock. I mean, if you had any expectation for earnings to return to Culp, any expectation at all, you could be looking at something interesting. Let's look at the 10Q one more time. I don't want to get this one wrong. Intangibles. So good, a lot of currents. And then we have total assets of 140 after intangibles. Equity of 84. It's just not cheap enough because it's not going to be below liquidation value. It's going to be right there near it if we get a slight discount on assets in a liquidation. Culp is going to be right there getting you your money back if they liquidated right now, but they've been losing money. So I don't know the story of the business. I don't know why they would come back to better margins or a better place. Culp Inc. What do they sell? I need to hurry up, by the way. I'm going to be way behind here. Culp Incorporated. Yeah, I mean, it's lucky to make that list. The needs more research. We'll just move on. Kiri, that's a hard one. I had a hard time with Culp. I don't think it was market beating. It was hard to tell. Okay, content assets. That sounds intangible. Content assets sounds intangible. That's my first impression on this 10Q. 106 in assets, 30 in liabilities. Accumulated deficit of $285 million, only getting greater since last year. I'm out immediately. Next stock. CUZ, Cousins Properties. This will be a REIT. I want an exceptional discount to assets if I'm going to buy a REIT. Assets 4.5 in equity. Intangibles are taking up only 100 million of that, so 4.4 in reported equity, and it's going to be mainly properties. 4.4 in reported equity. Paid in capital. They've made $1 billion in distributions. Most of it's paid in capital. And selling for $3 billion. Let's take a look at the net income. They just don't generate a lot on their properties. They haven't in the past. So it's going to be at about 18 times earnings right now. I don't see that being like it's one of those where the assets kind of mandate a minimum price, but the earnings mandate a lower price. So those two things conflict and it finds a middle ground. So it's fairly valued in my opinion. They've increased revenues a lot in the last 10 years. They've increased shares. That's not my type of stock. So, and it looks fairly valued. Next one, Chicago Rivet, CVR. I've actually reviewed this one before, and this will probably go on our watch list. Current assets, 18. Total assets, 30. Total liabilities, just 2. Chicago Rivet has an equity of 27.6. I've looked at this before, so I know a lot about it. They don't make a whole lot of money over time, but they've made a moderate net income over the last 10 years. It's all about whether or not it's cheap enough. They won't buy back any shares. They pay a little bit of a dividend, Chicago Rivet. And so I'm looking for Chicago Rivet, if it's got 27 in equity, to be selling for like 10 based off of the history of the business and how low the return on assets is. And let me show you guys that. Chicago Rivet revenue over time. Yeah, see, we don't get much of a net income. Over the last 10 years, we're averaging like 1 to 1.5 in net income. And then we actually lost the last 3 quarters, but that came off of a gain, so that takes more research. They do pay a dividend, so they do return some capital. And then if we look at the history of the way it's been priced, it probably deserves to be at or near below book value. At or below book value. You can see it's cheap compared to the last 10 years, but then there was a period back in 2010-11 where it was even cheaper, but it performed somewhat well. So CVR, I think this makes the needs more research list. CVR. CYAN, only 4.69 million. I'm going to guess this is in trouble. I'm going to just use Google in this. Lost last quarter. Yeah, just a continual loss. I've looked at this before. It's just a big loser. Next. CYN, software application. This one sells for only 7 million. Something's probably wrong with it. Total assets is 10 after intangibles. Total liabilities 1.3. That's a great ratio. And then accumulated deficit is 153 million. So they put in 163 and lost 153. That doesn't sound like a great bet. I'm out. DDD stock. .3D Systems Corporation. Goodwill takes up 390, so it's going to be about 1 billion in assets net. Net assets, 700 in liabilities. That leaves us with 300 in equity. And the stock is selling for 645, so it's at 2 times net tangible book value. I'm already out. DEA, another REIT. Easterly Government Properties, that sounds sus, so keep that in mind. Okay, so 2.8 minus the intangibles makes it about 2.7. Liabilities 1.4. Total equity of 1.3. They've paid a lot of dividends over time, so they've actually returned quite a bit of capital. They've returned about half the market cap in capital because it's 1.1 billion in market cap right now. They've returned 550 million. That's pretty good. And we have the equity sitting at 1.27 minus 1.4, 140 million. So we're going to say about 1.3 total equity. But it's not the best margin of safety at 2.7 to 1.4 ratio. So a 40% discount wipes all equity on if our assets go down, if the real estate properties go down 40% in value, we lose all equity. All equity. That's a very risky investment if you think about it. So I'm looking for something with a margin of safety that does not have the type of margin of safety that I'm trying to find. Fundamentally. So I'm out. DGICA. This one's selling for 462 million. 2 billion in assets. 1.8 in liabilities. That doesn't have a great margin of safety. I'm out. Digital Ally, DGLY. We've got 51 in assets, but goodwill takes up 17 of that. That's going to make it 34. Liabilities, 32. I'm immediately out. HF Sinclair, oil and gas, Dino stock. We'll take a look. Probably going to be fairly valued considering it's so large. Total assets of 18. Total liabilities of about 9. So 18 to 9 ratio. Do we have any intangibles sitting up there? Goodwill of, goodwill of 4, so 8. So sorry, our equity is going to be about 6. And if our market cap is 10, we're far below liquidation values. I'm out. I'm not going to even look at the earnings. DLTH. Duluth Holdings. Total assets of 500. But a good chunk of that is operating lease assets. Okay. Total liabilities, it could be a big asset dump. They do have retained earnings of 127. Duluth. 184 is their market cap right now. Duluth Holdings. Net income. So Duluth actually shows pretty consistent net incomes, but they've dropped off recently. They get most of their net income in first quarter for whatever reason. Have they bought back any shares? No shares bought back recently. Has the price fallen to cigar butt levels? Yeah, I mean, it technically has. I just don't think it's at 184 million, as we saw here. That's going to be fairly valued compared to the last 8 years of earnings, especially with revenues kind of leveling off. That feels fairly valued to me. So, and again, it's not a great margin of safety, not a great asset to debt ratio. So fairly valued Duluth Holdings. I'm moving on. Desktop Metal, 260 million DM stock. Goodwill and intangibles are taking up 270 of this, so 400 net, we'll say 400 to 238. That means an equity of about 160 and a giant accumulated deficit of 1.5 billion. I'm out. I'm not going to invest in something that loses that much money. DMTK stock, 51 million. Dermtech, 51 million. Total assets, 137. Total liabilities, 64. 73 in equity. That's pretty good. But look at this, guys. Giant deficit and enlarging too. So there's nothing there. Dermtech, worth nothing. Doc stock, DOC. Let's take a look. Physicians Realty Trust. $5.2. This is all real estate investments. 5.2 to 2.2. Okay, and they're valuing that at 2.67, so it's going to be fairly valued based off of, it's 2.67 market cap, 2.9 equity, so that's going to be pretty fairly valued if they were to liquidate the properties. I'm out. Next. Douglas Elliman, DOUG. Douglas Elliman. Total assets, intangibles are 100 million, so it's 400 to 263, not the best margin of safety. And then what's our market cap? 147, so we're already above net tangible book with a very poor margin of safety. That's going to put me out already. DRIO. DRIO. 106 minus the goodwill makes it 66. Liabilities, okay, so we'll just do it this way. Goodwill is 47. We only have an equity of 21 after we take that out. And then we have a giant deficit getting larger. I'm out. Dario Health. DRQ stock, 700 million. $1 billion to almost no liabilities. Lots of retained earnings. So they built the business on retained earnings. Drillquip is super intriguing. So 870 in shareholder equity, but it's fairly valued asset-wise at 770 million. Drillquip. Yeah. Let's look at their earnings. Haven't made any money since 2016. And then even back then, if we're selling now for 700 million, that was pretty fairly valued compared to the old earnings. So I'm out. I was out anyway. DSS selling for 20 million. Packing in containers, okay. $115 tangible assets. Only 47 in equity. And then the market cap is 20. Okay. But they have a giant deficit, so they're losing tons of money. Look at that. Tons and tons of money is draining out of this. They added 30 million to their deficit just last year. Wow. DSS out. DTC, Solo Brands. All right. Current assets. That's weird. Oh, so they have most of their assets in goodwill and intangibles, 640, in fact, which puts the true at only 250. And so we have negative shareholder equity after we take out the intangibles. I'm out. Solo Brands, I'm out. DYNT. Sells for so cheap that I'm concerned. $2 million is too cheap. There's something wrong with this business. It's about to go bankrupt. Yeah, giant deficit getting bigger. So they have 20 million in assets, 14 in liabilities, a shareholder equity of only 6. And they're continually losing money. And they have an accumulated deficit of 26 million. So they started with 35 million, lost all of it except for just a few $1,000,000. That's the story of that business, not the type of business I want to do business with. Dynatech. DZSI, $41 million. Is this the right stock? Yeah, it is. DZS. Total assets, 310 after the goodwill, and then 310 to 230. 310 to 230, that means we have an equity of 80, but a very thin margin of safety asset-wise, very thin. Accumulated deficits getting bigger. So we know that they're losing money. It's a lost cause money-wise, profit-wise. Market cap is 43 million. So that's going to be fairly valued. Let me make sure though, just by looking at earnings, there's no incredible change undergoing. Yeah, they're losing money continuously and it's getting bigger. So this is a business going to bankruptcy, DZS. You don't want to touch it. Next stock is a bank, skip. EBS, drug and manufacturing, 106 million. EBS, emergent biosolutions. You always got to look out for giant deficits on stocks like this. Total assets, oh gosh, there's a lot of, so there's no equity after the goodwill. I'm out. I'm not even gonna waste my time. EDUC, $7 million stock. Let's take a look. Total assets of 60. Total current, 100 of total assets. 60 in liabilities. So 100 to 60. Oh, 100 to 60. They've retained more than they've paid in. EDUC is interesting, at least so far. Why is it only selling for $7 million? Let's try to figure this out. Why is this business selling only for $7 million? So we have inventories dominating the currents. It could go bankrupt. That's what's going on here. That's what's going on here. They don't have any cash or receivables. It's all inventory. Let's use their... So revenues have been somewhat consistent. EDUC. Is this a Chinese business? What happened here? EDUC. What am I looking at right now? What am I looking at? Why is it so cheap? So EDUC $98 in assets, $54 in liabilities, $44 in equity. Why they started losing money, but this is a book selling business. They were profitable for a long time. I mean, this business stresses the importance of paying out capital, that's for sure. Holy crap. EDUC, incredible. This one needs more research for sure. I would be super curious to see what's going on. Let's actually look at the last stock. Is there anything in the news about it? Company's inventory is bloated. Unrealistically low inventory valuation allowance. Whack earnings. So they think the inventory is overstated. Net revenue. See, I don't understand why they wouldn't start paying out capital. EDUC needs more research. We're going to put that on the more research. More research needed page. That's one that's confusing. EEIQ. Epic Quest. Oh, they haven't been around very long. I'm just going to skip it. Bank, skip. Eagle Bulk Shipping, 400. and 23 million EGLE stock. Eagle Bulk Shipping. Let's look at the latest 10Q yet again. Selling for $400 million. Okay. Almost all of their assets are vessels, which is always a huge risk because the money almost never comes back. So it's just below equity, and they're running a deficit. I'm out. Eagle Bulk Shipping. And then I never can predict the bulk shippers either because their earnings are so volatile. Inhabit. EHAB. Revenues are going down. Big losses. Assets 1.5 billion. EHAP. Goodwill takes up all of it, so Inhabit's a waste of time. EHTH. eHealth 218. Let's go get that 10Q. So, equity of 560. Contract assets are most of the assets. It's a 1-4 ratio asset to liability, which is pretty good. They've lost money over time. They lost money over the last year. eHealth. eHealth. It is selling very low compared to its assets. Oh, they haven't made any money over the last 10 years. I'm out. Have they returned any capital is another question. No, they've issued shares over the time. I'm out. ELAN, Elanco Animal Health. Man, people are going to do horrible the next decade, man, on average stocks. I mean, I can tell just going A to Z and everything, man. Average business is awful. So look at this. 9 of their 14 is goodwill. So I'm out. Electrosensors, ELSE for 13 million. Total assets is 14. Almost no liabilities. They do have retained earnings that have built the business. What's it selling for? Electrosensors. So it's selling just below book value. ELSE. So it's fairly priced compared to assets. It's got to be mispriced compared to their net incomes. And as you can see, they almost make no net income. So not worth it. MCore Group selling for 30 million. EMKR. Temcora. They haven't generated any profit over the last 20 years. They've increased shares. MCore, I'm out already. Yeah, I'm kind of curious to see the 10Q real quick. MCore Corporation. For fun, we'll look at the 10Q. Goodwill, they're carrying for 20, another 15, and other intangibles of 35. Make that 140, 138 on top of, and we'll just take the 45 out of this. So they're carrying 60 in net equity. Accumulated deficit of 655 million, my good Lord. They're wilding out there. EML stock. The Eastern Company, selling for $113 million. EML. Total assets of 256, but we've got a lot of goodwill. 70. Make it 190. 190 on 130 for an equity of 60. That means we're at 2 times net equity. We do have retained earnings that have built the whole business, so that's good. The Eastern Company, I'll give it a chance. Let's just look at recent. So trailing is 5 million. Yeah, it's fairly valued, guys. It's probably overvalued, but it's a good business. It's a business that makes money over time. Like, I would comfortably hold that business for the right price. It's just too expensive. The Eastern Company. Enovis Corporation, ENOV, selling for $3 billion. $2.4. So we've got negative equity by a lot after goodwill. I've looked at this one before, ENSC, it's no good. Giant losses, that's why it's selling for $2.85 million. Next stock, ENTA, for 190. With all these pharmaceuticals, they tend to have giant accumulated deficits. Total assets, a lot of current assets. Okay, this one's quite interesting. They do have an accumulated deficit, and a big one that's growing. Equity of 230. Okay, so it's selling for its asset values, and they've had a deficit over time. I'm out. Unless we have incredible profits as of recently. But I have a feeling we've been losing money. 40 million last quarter. Okay. Equilium Inc., EQ stock. Okay. Equilium. $59 in assets, 32 in liabilities, 27 is the equity. Equilium. selling for 17. They've increased shares. And we lose consistently. I'm out. Equilium. ETWO. Software business. $3.8. Oh, it's all goodwill, guys. So the entire business is goodwill. It's below net equity. Fantastic. EVTV for 21 million. For 21 million EVTV. 14 in assets, 1 in liabilities. So they have an equity of 13, not including the goodwill, and they've lost 61 million. Yuck. EZPW. We'll take a look at the latest 10Q. Um, 1.1 billion in assets, 700 in liabilities, so total equity of 400, minus after the goodwill, retained earnings of 402. So Easy Corp. But it's selling above book value, folks. So it's going to have an okay margin of safety. We'll take a look at it. EZPW. Revenue over time. Net income over time. Not enough to justify the current price. So it's probably very fairly valued or even overvalued based off of the low earnings here. 10 times, 12 times earnings, yeah. Fate Therapeutics, FATE. $543. On 130. $543 on 130. They've lost one. They have a giant deficit, though. I'm out, guys. Phase Holdings. All right, we'll take a look at Phase Holdings. Let's see about Phase. Total assets, 40. Total liabilities, 20. Equity of 20. Look at this. They have an accumulated deficit of 316 million. Phase stock is a disaster. A disaster. FBMS. Bank skip. FCAP bank skip. We'll actually look at FCAP because it's saying it's at 6 times earnings. We'll take a look. I think with a bank, they like to manipulate their earnings so that they look good. And it's just hard to believe that they can maintain that with how many assets they have. Did they buy back shares recently? FCAP. I'm going to look and see if they bought back shares. I think they might have. Not recently. All right, we'll skip it. FCEL, fuel cell. They just lose money every freaking corner. Wow. Good luck. My goodness, man. This should be inspiration for anybody that ever wants to open a business without making any money. FCEL. Amazing. So we're going to move on to FDP. Fresh Del Monte Produce. For selling for $1 billion. So it's going to be 2.8 over 1.3. That's pretty good. They do have retained earnings over the market cap. Most of it's in property and equipment, though. That will need to be looked into. Fresh Del Monte stock. Okay, it has the cigar butt characteristic of having been low priced compared to recently. Increasing revenues, and then pretty consistent net incomes as well. So, interesting. FDP. Okay, and I hope they've eliminated some shares. Okay, so they have eliminated some shares. FDP might need some more research. FDP. I'll put on not cheap enough. Stocks to watch. FET. Forum Energy Technologies. $828 intangibles are going to take up, so 570 to 411 or so. 160 equity. Forum Technologies. It's going to be above book value. I'm out because of how poor the asset-based margin of safety is. Only a 20% discount wipes everything. FF stock. Oh, we got cash. Lots of cash here sitting in Future Fuel Corp. 345 in assets. Total liabilities of 48. That's looking good. Total equity of 296. Fuel. That's fairly valued. That's the problem. And we have retained earnings of 14 million. Future Fuel Corp. FF revenue over time. Let's look at net incomes. We'll give them 50. If it's 50, does that make it interesting? They pay a big dividend. They do pay a dividend at Future Fuel. Let's look at the 10Q again. Look at the 10Q again. So it's fairly valued compared to assets, and then slightly cheap compared to earnings, basically. So I'm gonna skip that for now. Then the next two are banks. FGF, insurance. $58 to $16. Yeah, it sells for $15 million. Big deficit though. FGF. Big losses over time. Big deficit over time. I can't be too interested in that. FGH. FGH. $27, it's a leisure stock. So 57 to 30, basically. So fairly valued according to net equity. And then we have very low retained earnings over time. I'm gonna guess this is not worth it. FGH. Just gonna take a look at the stock price. Yeah. What's the name of it again? FG Group Holdings. Okay, we're just gonna move on. Sorry, guys. Then we've got 3 banks in a row. Yeah, we can skip those. FKWL. Franklin Wireless. $50 in assets, 10 in liabilities. That's an equity of 40. And then we have retained earnings of 28 million. That's pretty good. Oh, but it's fairly valued according to asset values. Not a great margin of safety. Franklin Wireless Corp. Asset-based margin of safety. FKWL. I'm gonna look at their revenues and net incomes over time. One surge of good net income. There's nothing predictable here at all over the last 15 years. It's pretty much dead assets. So I'm going to skip. It looks fairly valued. Foot Locker at $2 billion. Goodwill, 6.4. Total liabilities, 4.2. 6.4 to 4.2. 2.2 is our equity. We do have a lot of retained earnings, which is great. And then Foot Locker, selling for 2, so it's selling right at net tangible book. And then oh my gosh, why does the search not work on this site? Very frustrating. We have 2 in equity. Sells for 2. But our earnings history says we can make 400 million if that's normal. We have been reducing shares. Let's see how the price has compared. Foot Locker. We'll put that on our not cheap enough list. FLGT Fulgent Genetics. $1 billion in assets, and then only 100 million in liabilities, 900 million in equity. Fulgent Genetics. What is the market cap? 800. So it's pretty fairly valued in comparison to their assets. They've retained 761 million in earnings. That's pretty good. Fulgent Genetics. But the thing is about this business is it's so unpredictable. As you can see, they gathered all their net income. It's priced as if that all is going to pay out and they're never going to make any more money again. Issuing shares, not... They did pay repurchase a few shares here recently. You can tell. Dividend. Oops. No dividend. Yeah, it's too hard to read this one. I'm going to have to skip it. So... FLXS, Flex Steel. Pretty consistent revenues at 400 million. 20, we'll say, if we're generous on the profits. Whoa. FLXS. This could be something. This could be something. Flex Steel, 280 in assets, but a lot of that is going to be our operating assets. Ooh, this could be something, guys. This could be something. 280, but really it's 220 if we're not doing operating leases. And then it's 220 to 80 with a lot of retained earnings. This gets my heart beating a little bit. This one's nice, man. Flex Steel Industries, what's the market cap? 96 million. Wow. Hold on a second, folks. FLXS. Flex Steel. Let's look at the market cap. Folks, we may have found something interesting here. Flex Steel Industries. Okay, it's very cheap. We'd have to look into these losses. Flex Steel Industries. Now, what did they make 10 million on? FLXS. We'll put that on the not cheap enough. They are reducing shares. So they're paying 3 million. What? Okay, so they're repurchasing a good amount of shares. FLXS, that's very interesting. FLXS is. I think if it was 50% cheaper, I'd be super interested. But it's on the list. FNB skip because it's a bank. FONR. Fonar Corporation. Total assets, 196 after the... So 196 to 47. They have a deficit. Equity of 154. Fonar. This is probably fairly valued. Increasing revenues. Wow, Fonar has not lost money in the last 20 years. Sorry, not 20 years, but 10. Fonar stock. They've issued shares, which is a little bothersome. Fonar stock. Their equity is made out of current assets. Fonar Corporation stock. They must have lost a lot of money between the year 2000 and the year 2010. In fact, they definitely did. That's why they've only made money over the last 10 years. So that would require a very deep investigation. I'm going to skip it. We have Friedman Industries, last one on this page, FRD stock, 93 million. $222 in total assets, 93 in liabilities. Pretty good current ratio. Very good current ratio. We do have retained earnings, which has built most of the business. Friedman Industries, total equity of 126. They profited from have more equity than last year. Premium Industries. I'm going to say it's probably fairly valued without looking at earnings, but let's take a look. FRD. Macro Trends needs to fix their search. Okay, so on average, we're not doing that much in net income. At 90 million current market cap, it looks fairly valued compared to our average earnings. And are we eliminating any shares? No. No. So FRD is probably fairly valued. Back at it with stock number 201, Fresh Tracks Therapeutics, $5 million, FRTX. Let's take a look. 10Q. Early morning, guys. I just woke up and got a workout in. I'm now going through the rest of the list. Total assets. Okay, well, they have assets of 13, liabilities of 2. Oh my gosh, giant deficit of $170 million. Ugh. Sells for 5. And the deficit's getting larger, guys. That's not a good stock. Next. FSP, we're skipping banks. We're going to FSP. Franklin Street Properties. This is going to be a REIT that owns land or buildings. Total assets of 1.2 billion or so. Total liabilities of 440. That's not bad, guys. That's not bad. Assets are going to be expressed in buildings and land. This business is running... Oh, they've distributed $600 million over the course of the business. Very good. Almost no retained earnings. Am I looking at this correctly? Yeah. Accumulated other comprehensive income. I guess it doesn't say retained earnings. So FSP over time. Franklin Street Properties. Averaged out net incomes over the last 15 years, we'll say 12, maybe 14. One big gain in 2021, probably on a property sale. That's how those REITs work. Let's see if they bought back any shares. Okay, they bought back some shares in 2022. FSP, what's the market cap? 249 is the market cap. Franklin Street Properties. Well. This could be interesting. Franklin Street Properties. 1.1 billion in assets. 440 in liabilities. FSP, they only make a 1.6% dividend or pay. That's weird. FSP, are revenues really going down? Yeah, revenues have gone down a lot for whatever reason. But with REITs, you'd never know because it's just going to depend on what properties they were getting money off of. FSP, so it's only selling for 200 million? FSP. Okay. I suppose compared to historical earnings, let's see how it's been priced compared to shareholder equity because there really isn't any intangibles. Let's see if it just recently fell below book value. I think it might have. Price to book ratio. Okay. So it's always been valued below price to book. That makes sense. That makes sense. It's been at an exceptional discount recently. But if it doesn't earn enough, it deserves to be below book like that. So let's think about it from an earnings perspective. Franklin Street property sells for $250. And let's just average out their earnings again to see, because it'll tell us something. Yeah, so based off their historical earnings, off of revenue, they're actually fairly priced compared to earnings, probably at 15 times normalized earnings or so. So I'm gonna skip this one. Weird though, Franklin Street properties probably deserves to be priced below book that far. FTCI. FTC Solar Incorporated. $130 after goodwill in assets, 62 in liabilities, 70 in equity. They have a giant deficit that's just getting larger. Look at that. So if you see a deficit that increased by 40 million from the last year, they lost 40 million. And it'd be exceptionally ridiculous if they paid that out somehow. So I'm out. Fuel Tech, FTEC. Wait a minute. FTEK. Fuel Tech. And this pollution business is selling for 30 million. The pollution businesses typically have very uneven profits. $48 in assets, total liabilities of 6. Shareholder equity of 44, 42 after goodwill taken out. But they have a giant deficit, so this is a lost, this business loses money over time, and by a long shot too. Fuel Tech, what's the market cap? 32. Without even looking at the earnings, I'm gonna guess that's justified. Fuel Tech, but let's look at earnings anyway. Let's look at earnings. Terrible. So I'm out. I'm not surprised with a deficit like that. FTFT software business, 10 million. Software. No, this is the wrong, I'm looking at the wrong one. Huh? It's FTFT, Future FinTech. Oh, I see what's going on here. So this business, let's look at this business. Future FinTech. $14.5 in intangible assets. We'll take that off of the assets. Total liabilities of only 30. That looks good. Total stockholder equity after goodwill is 46. 46 is our total stockholder equity. But here's what's concerning. At 46, net tangible equity, that's down from paid-in capital of 220 million. So something is seriously wrong with the business that's losing giant amount of money. They do have a lot of cash. Advances to suppliers and other current assets. Yeah, the currents alone get us there. Future FinTech Group. Let's take a look at their earnings. I'm going to guess it's really bad. So they don't generate any revenue, and they probably have obligations. Future FinTech. Shares outstanding. They've issued shares. Where's this business from? I'm going to maybe guess it's from China. Future FinTech. Yeah, they have a Beijing office. That's probably their main office, but they're listing in the United States. I have a bad feeling about this business. But I'm confused about this one. I'm confused about Future FinTech stock. So they've had, wow. Weird. They don't pay out their money over time for whatever reason. Could be one of those scam stocks that lists from overseas and then makes the headquarters in the United States, even though it's really an overseas business, and then they just take your money. That's probably what it is. Yes, that's why it's important for people to pay capital out to you. Future FinTech. Skip. Weird one, but we'll skip. Skipping banks. Arcimoto, FUV. Uh-oh. I know this one's going bankrupt. I know it. Yeah, total assets. Oh no. Oh, they have 10 million in intangibles, so 43 over 32 with an accumulated deficit that grew 20 million last year. Wow. So, pass. Fun business, probably. Gaia. Gaia. Gaia stock. $108 after goodwill, over 51. And then what's the market cap? 60. So we're already right at net tangible book value. After we take 31 million in goodwill out, accumulated deficit growing. Not going to be my type of business. Looking for cigar butts that are profitable. GBLI. Global Indemnity Group. $460 million. Let's see if we can figure this one out. $1.7 to 1.1. So remember, if we discount their assets at probably about 30%, 35%, we're going to lose all book value. That's an okay margin of safety. We do have retained earnings here, so that, and they've grown, so we're probably looking at a business that's making money over time. Total shareholder equity of 630. But remember, with financial products, you never know what your margin of safety is. You have to look a lot closer. So it's at 462 million. Let's see if it's at a really low multiple to normalized earnings, because that's the only thing that could dig it out of this hole. It's pretty expensive. And it just doesn't have the best margin of safety. It just doesn't. Trailing net incomes of about 20 maybe. So it's probably a very fair value to earnings, probably even overvalued, and then relative to assets, it's nearing undervalued. It's one of those dilemmas. Not interested. Global indemnity. It almost feels like it's worth that price, 462 million. That's very fair valued on the high end. Green Dot Corporation, GDOT. Let's take a look. So Goodwill's taking up, we're 4.2 after Goodwill's taken out. 4.2 to 3.9. That's a horrible margin of safety. I don't even know why this came up on my screener. Green Dot, you're skipped. GHC. Graham Holding Company. Ben Graham. Ben Graham. Total current assets, total assets of 5 billion. Total liabilities of 3. So if the market cap is 2.8, that's already way too expensive for what we're looking for. We're looking for something well below liquidation value. We know it's very rare to ever liquidate above what they reported. But let's just take a look. Retained earnings. Look at this, guys. That's impressive. That they have retained earnings of 7 billion. This must be a very profitable business. Graham Holdings. Okay. Let's look at their earnings history because I'm curious now. Not surprising. Very, very good earnings. Graham Holdings. And do they buy back shares? They do buy back shares. Graham Holdings. GHC stock. Has it gotten cheap recently? No. So they own the Washington Post. That makes sense. That makes sense. Shareholder equity. Let's look at their price to book. I want to see how this has moved. And then their assets, I think they have a really good return on assets. Oh, never mind. So they're holding 4 to 6 over the last 10 years, and they're getting, okay. Yeah, they're profitable, but they don't have the best return on assets. It looks fairly valued now that I'm looking closer. 2.8 billion. Good. That's good from the asset perspective, but from the earnings perspective, that might actually be even a little overvalued. So that's probably very fairly valued at Graham Holdings. Okay. Next stock, Guardian Health Sciences, GSHI. Guardian Health Sciences. Total assets of 13, total liabilities of 5, total equity with a giant deficit. That means they've had a disastrous business run. 93 million in deficit. Now you can work out of situations like this if you know how the end of the business is going to look, but that's really not what I'm looking for. I'm looking for a profitable business that's just too cheap. So I'm out. Gulf Island Fabrication, GIFI. Total assets, 118 to 49. So that's a very good ratio. Total equity of 69, but they have a deficit, so they're losing money they have a deficit of 48 million. What is the market cap? Gulf Island Fabrications. So it's 70 million market cap. That's very fairly valued relative to its assets. That's probably overvalued if it had to liquidate, so there's got to be something here in their profits. Let's see if they've done okay. No, they do horrible. So that business is probably overvalued. They've lost a lot of money over time. Issued shares, that business is overvalued. Gulf Island Fabrication, overvalued, in my opinion. G3, folks! Guys, I own G3. This is one of my favorite stocks because I put 1/3 of my net worth into G3 back between September of 2022 through December of 2022. And I made a video on it. If you want to check it out on my YouTube, it's one of my best videos, and I ended up making a 80% return on the stock in total. And I still hold a good amount today that I'm waiting to sell at the start of the year. But I bought G3 on average right about a $685 million market cap. And today, G3 sells for 1.28 billion. A lot of my shares are actually up over 100% now in about 1 year. So G3 was one of my best investments ever. Let's review my investment and see what I was looking at with G3. So right now it's selling for almost 1.3 billion. But let's look at the 10Q and see if that's fair. So we have total assets of 2.0 to 2.1 after the intangibles, 2.0. Total liabilities of 1.2, so shareholder equity of 700. And then we have retained earnings of 1 billion. And the thing about the retained earnings is that it was actually higher before they bought back some shares. And so they really have higher retained earnings than that. And that's one thing I noticed about G3 is when I was buying it at a $700 million market cap, is that I felt like I was buying into a super profitable business. And it's one of the most profitable businesses I could find in the market. But you can see here, paid in capital, 440 million. And we have an equity after intangibles taken out of only 750 to 800 net tangible. But when I bought that at 695 or 685 on average, that was going to be right there about 0.8 to 0.9 net tangible. And so I bought it at 0.9 net tangible. And then it was the earnings of G3 that really impressed me a lot. And so let's look at the earnings history. G3. Purchase. Let's show you guys. So we have growing revenues. And then the great thing about G3 is that I felt they were a super profitable business. And so you can see that we actually have net income in the trailing 12 months for every single quarter, except for the write-down of the intangibles here in 2023. But that write-off actually didn't decrease the value of the business. That was them writing off their intangibles to nothing. And so my theory when I bought G3 at $685 million market cap is that I was buying into a business that was going to make $150 million in sort of a normalized year. And so I felt like I was buying it at about 4.5 times earnings. And that was a very reasonable thing to predict when I got into the business more, because I was able to go through the recent purchases they had made for different brands that hadn't shown in their earnings. I was able to go through the way that their brands had performed in the past, and how much, and I even looked at the revenues over time for each of the brands to see how they were doing, if they were falling off. And G3 has done well historically in terms of return on invested capital. And as well, they've done well in terms of return on assets. And so in the very long history of G3, that's really a metric that I cared about. And then as well, they had an insider purchase from their CEO, which spurred more purchases from me. And then they've also bought back shares recently. So these are all things that I was looking at or looking for when I made my purchases back in late 2022. And you can see here, since my purchases, they bought back about 4% of shares. And so I thought I was buying something at 0.9 net tangible, not the best margin of safety, but I felt like I was buying the top idea in terms of current earnings. I felt like G3 really sat there at 4 to 5 times earnings in plain sight, more or less. And it has turned out to be true too. So G3. Next stock is GNK. It's one of those marine shipping businesses that have very variable earnings. Let's take a look. Total assets of 1.1, but that's going to be almost all vessels, which is super risky. Total equity of 900, but a giant deficit of 650 million. So this is a business that loses a lot of money over time. They probably write off those vessels at a super aggressive rate eventually. But I would not trust the equity here. What does the business sell for? Genco sells for 600 million. That's fairly valued without even looking at anything else. Without even looking at anything else. GNLN, $1.5 million market cap. Let's see what happened to GNLN. When you have a 1.5 million market cap, it's hard to justify being a business. Total assets, 114. But intangible assets, this is why intangibles matter, everybody. 50 million for intangibles, we'll say. And so that takes our equity down to only 25. And then we also have a giant accumulated deficit that's only increasing. So you cannot assume that these currents are going to be worth what they're stating. They're not going to be. So the inventory needs to be written down at the rate that you're losing money. And so I would take another 10 off of the equity for that. And so I'm taking 60 off of my total equity. That brings me down to 15. And as well, they're probably going bankrupt. Yeah, it sells for 1.5 million. Paid in capital, 260, loss of 190. Yeah, they're just dumping. They're just losing money. They lost 20 million in the last 12 months. So within the next 12 months, they're expected to lose all their equity is how it's priced. And it's expected to go bankrupt within the next 12 months. So G&W. Genworth Financial Corp. Assets. Jesus. What am I looking at? I didn't get a 10Q out of that search. That was wild. Here it is. So we have total assets of 89 billion on Genworth. Total liabilities of 81. There's no margin of safety. I'm out, folks. I got to save my time. Next business is Grom, Grom. I actually already know that one's going bankrupt, but we'll take a look. We'll take a look. We'll take a look, folks. We'll take a look. So immediately, 16 million of their assets is goodwill. 6 is their actual asset total on 3.7 of liabilities. So their equity is only 2.3. Accumulated deficit, oh my gosh. So yeah, they started out with $100 million. They've lost 88 of that. And as well, the rest of that is just junk intangible. So you can't say that your intangibles are worth anything if they lose money like that. So total equity is 2 million, going to be zero in the next 12 months. And Grom is social enterprises going out of business. GRWG. Grow Generation Corp. It's a specialty retail business. Let's see. 163 in current assets, 40 in intangibles, 237 is our net assets, 237 on only 77 in liabilities. That's a great ratio. That's a great ratio. That's what we're looking for. Equity of 160 after intangibles. Deficit, though, of 170. Yuck, 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 yuck. So they're losing big amounts of money. Grow Generation Corp. Grow Generation. Grow Generation. Sometimes you have to search this in Google. It frustrates me so much. And then you can pull it up on macro trends. So they're just losing money hand over fist, it looks like. Big write-off. And then trailing 12 months, negative 34 billion. I cannot be interested in a business like that. Grow Generation. Specialty retail. Are they growing revenues real fast or something? They were. It's a bubble business. Yikes. Yikes, folks. Yikes. Greenland Technologies. I had an experience with this one. Greenland Technologies. So first of all, it's a Chinese business. I learned my lesson. But I should have held on because I recommended GTEC back when it was at a $20 million market cap, and then I ended up exiting. Let's take a look at Greenland Technologies 10Q. What was I looking at? How did I get tricked by this business? I still think it could be a scam business. So remember, a lot of these assets are going to be in China. That's number one. So it's hard to say that they're worth what they're stating them for. Total assets of 154, total liabilities of 67. 154 to 67 is a very good ratio because if you discounted those assets at 50%, you'd still have a little bit of equity. So they have retained earnings of 41 million. I think that's what intrigued me when it was sitting at 20 million, is that they had retained earnings at that level. But this is one of those Chinese businesses that's a value trap, in my opinion, because they don't pay capital back to you like they should. And in the world that we're in today, it's hard to justify ever trusting one of these balance sheets. So you need to look out for businesses that are listed from China that look like American businesses, but they're not. But you can see they're making a net income for the last 3 months of 2.9. That's amazing. They're issuing shares heavily, though. That's all the idea is that these businesses are taking your money, over-reporting the assets, and then it's a big pyramid scheme, basically. And they benefit from getting your money, and you never get it back, and it's never traced either. And so while I'm right to look at GTEC and think that it fits all the bills for being of great value stock, it does. The problem is that you can't trust the government. You can't trust what they're saying about their assets. It's happened too many times where businesses from these other countries are scamming American investors by over-reporting what their assets are worth. because they're never held accountable for lying. So Greenland, do your own research. Yay, we're skipping a whole bunch of banks. HF Food Corporation, HFFG. Total assets. Customer relationships. Interesting. I'll be generous here. Sometimes intangibles are worth something. I'll be generous and say they have 500 in assets. Total liabilities of 330. 170 in equity. What is our market cap? HF Foods. 249. Okay, so that's above book value. They have an accumulated deficit that's getting larger. Here we go. Yeah, they're just losing money, guys. They've never made incomes to justify the current price. So HF Foods is out. Bank skip. Hippo Holdings, HIPO, only 190 million. $1.6 in assets to 1.2. So that's just not a great margin of safety. If you discount their assets at 25%, you've lost all your equity. Not a very safe position relative to other things that you can find. And then a giant accumulated deficit of 1.1 billion. They're working with equity of, and it's grown by 200 million since last quarter. I'm not looking for a business like this since last year. Next stock. HLTH, Q Health. HLTH. Q Health revenue. Giant losses. Giant losses. Giant losses. Assets, they have a great asset to liability ratio. But intangibles taken up, only 21 million. Their equity is 388. Giant deficit that's building. So 388, and then what's the market cap for Q Health? Yeah, they're expected to go out of business. Whatever's going on. Revenues have plummeted to nothing. So Q Health was some sort of bubble stock. Whatever happened there. Not the sort of thing I'm interested in because I need to be able to predict future earnings to some extent to be able to buy something. I don't know. HLX. Helix Energy Group. Oh, let's see this shitter. Total assets. 2.4 billion. Total liabilities, 900. Property and equipment is the dominating line item on the assets. Retained earnings of 300. So somewhat profitable over time, it seems. Helix Energy. Let's look here. Sells right at book value. It would have to be exceptional in terms of future earnings and with only, let's see, Helix Energy. We know they've profited over time. Yeah, look, as you can see, they fluctuate with oil prices. So it's about fair value in terms of assets. It's just an asset-based price. Q Health. Bank, skip. HNNA, Hennessy Advisors. HNNA. Management contracts is 81 million of the assets. That's a giant red flag. Management contracts. What is a management contract asset? We'll give them that. Let's see if does it add up? I don't think that adds up. You want to watch out for that. All the equity is in management contracts. That sounds suspicious as anything I've ever heard in the world. Management contracts? Hennessy Advisors. I might have to tweet about that. I think I'm going to tweet about that. Everybody. Yeah, I'm skipping that. Because I don't know what management contracts means. Next one is Hoft, Hooker Furnishings Corporation. Hoft. Intangible assets, goodwill, 45. So 305 net assets, it looks like. So 305 to 124. Equity of about 180. And our market cap is 197. So we're already going to be out, guys. Retained earnings, they've built the business out of retained earnings. I'll give them a shot in terms of exceptional earnings. Hooker Furnishings. Hooker Furnishings. Market cap is 197. If you expected Hooker Furnishings to report earnings above 30 million, that would make it an interesting play. Now, they actually reduced shares. Hoft stock. Hoft stock. Yeah, if Hoft stock was at 100 million instead of the current price, we're going to put that on not cheap enough. But that would be a worthy cigar butt. Let's take a look at the assets again. 163 in current, low property and equipment, and then it's big operating leases. This is a good business. This is a good business. It's very profitable over time. And then retained earnings are exceptional at 175, whereas they only paid in 50. That's a really good sign, good business. So Hooker Furnishings is a good business. I just can't, it's not cheap enough. Hook, H-O-O-K. assets. Property, plant, equipment. Non-current assets. So we have 164 in net assets. Total liabilities of 68. That's pretty good. But they have a giant deficit of 300 million that's increased from last year by 50 million. I'm immediately out because of that. Hookipa Pharma, you're out. Bag skip, Werewolf Therapeutics. Howl stock. Howl. Werewolf Therapeutics. $176 in assets, 63 in liabilities. That's a good 3-to-1 ratio. After you take out the operating leases, it's a little bit better too. So equity, but a giant deficit. Man, that's so heart dropping. I hate the deficit, man. Skip. Those therapeutic companies have giant deficits. HPE. I have a feeling Buffett bought HPE. It's $20 billion stock. Let's take a look. I have a feeling it's an earnings play. Current assets, total assets. 40 after goodwill's taken out. Total liabilities. Oh, after goodwill's taken out, there's nothing to it. So next, we're looking at a REIT, HR. Healthcare Realty Trust. $13 to $6. After goodwill is put in, it's 12.7 to $6. 12.7 to $6 for an equity of 6.8. They've paid in a lot of capital. But have paid out a lot in dividends. So they have accumulated a net income. I do believe dividends take out of that though, so that's a good sign. This could be interesting. In terms of earnings, it could just be cheap. HR. So reported net incomes of 100 at best. Yeah, what am I looking at? Issuing shares too? I'm out. What am I looking at? HSON. Total assets. After goodwill is 53. Total liabilities of 14. That's a great ratio. 53 to 14 is a great ratio. But a giant accumulated deficit. I'm out. I'm not wasting my time. HT, Hersha Hospitality Trust. $1.4 right of use assets, tangible assets. Not too bad here. 1.4 mostly in hotel properties to 651. So remember, if you have a 50% discount in the value of those properties, you lose everything. Dividends. Giant deficit? Or no, distributions. So distributions in excess of net income of 514. Very good. So Hersha Hospitality Trust sells below book value. Hersha at 400 million. That's not bad. And net incomes Oh, shoot. They just haven't been profitable. Now, if you want to trust their reported assets, but again, 25% discount on a liquidation or real estate drop, you're gone, man. So Hersha is a no-go. All banks, I'm skipping them. HURC. Consistent revenues. Profitable, HURC. Not profitable as of lately. It could be left out as a cigar butt. Shares outstanding decreased. HURC assets. Let's take a look. Herco. September 8th. So a lot of currents. That's good. 261 in currents. Total assets of 300, so it's almost all currents. Total liabilities. Whoa, 300 to 75. Almost no liabilities. 225 in equity. What's the market cap? Herco. Herco. Net income. And then price to book. This probably fell. Ooh, guys, this is a nice little. I mean, book value per share when double up. So it's book value per share doubled. They did pay out. Let's see if they pay a dividend. They do. They pay a 3% dividend. Herc. This is one of the more interesting cigar butts I've seen so far, everybody. Yeah, this is one of the more interesting cigar butts I've seen so far. This would need a good research back to 1983. But retained earnings, I mean, that's pretty good. So Herc is a cigar butt, just not cheap enough. HURC, that's added to the list. Herc, cool. IAC. Assets. 6 after goodwill. Equity of 4.2. But they sell it for they're selling it half net tangible, 2 times net tangible book value. I'm out. Bank skip. ICCH. It's only a $40 million. $200 million in assets. $200 to $150. That's not a great margin of safety, everybody. They do have good retained earnings. ICC, 50 in equity. ICC stock. Let's look. Revenues have been heavily increasing for whatever reason that needs an investigation. And then they have been consistently profitable. IHCC. No shares repurchased that I can tell based off of those averages. Weak margin of safety, and then not great in terms of past earnings. I'm out. ICD, 33 million. $406, all property and equipment. That's a horrible sign, folks. To 200 in liabilities, gigantic deficit. I'm out. Get me out of there. ICUI. Goodwill and intangible take up 2.2. Make it 2 in assets. No equity after intangibles are taken out. I'm out. IDEX. Ideonomics. $200 of their assets are intangibles. That's disgusting. So they have negative shareholder equity. Yikes. Good luck, everybody. INBS. $2.6 million. They're going to have a giant deficit. Yep, next. It's that easy sometimes. Bank skip. INGN. $225. Make it 300 to 113 for a 187. Accumulated deficit is on pretty big. So 117 Inogen. Oh, it's already above book value. I'm good. Especially with a deficit, I'm good. IPI. Most of their assets and property and equipment, that's not the best sign. 800. And then total liabilities of only 72. Okay, interpret potash. Sells for 255. And their equity is 720. Okay. So, cost of goods sold. They had a big operating loss. They're losing lots of money right now for some reason. Something happened. Interpret potash revenue. They're a fertilizer manufacturer. They do fertilizer. Interesting. So in general, they're losing money. And then are they buying back shares? Please, no. So they're probably sitting at below book value. Management's letting it sit below book value? Yep. Management is letting it sit below book value. Are they paying a dividend? You gotta be kidding me. Your stock falls to 0.2 book value or whatever and you don't start paying money out? What the F, man? I mean, warning flag would be that they've been around, since 2008 and they haven't made any money. That's a big red flag. And then the other red flag, if we look here, is that their currents, 146 in currents, like their whole assets are all property, plant, equipment, and mining. So the biggest part of this is going to be machinery and equipment, which could be worth almost nothing. I'd have to know more about the business. Interpret potash. Like, why? How does your stock get down to $10 and you don't start doing something about it, is my question. But if you look at the last 5 years, it has the cigar butt quality, man. Like, it's just not profitable enough. I'm going to skip it. It's a weird one. iPower, IPW. $48 to 30 to 21 for 48 to 31 for an equity of 17. Accumulated deficit is growing. I'm gonna just be out. Yeah, it's very poor margin of safety. Asset to liabilities is not good. IRT, Independent Realty Trust. All real estate investments, 6.5 to 3, so a 55% discount would lose everything. Just keep that in mind. That's pretty good for real estate. Deficit, a running deficit, which is not the worst sign in real estate. What's the market cap? $3. Yeah, so that's fairly valued. Next. IVAC. Currents, it's all in currents. That's really good. 155 to almost no liabilities, but they have a big deficit running. That sucks. Intevac. Yeah, it's going to be fairly valued with a deficit like that. It's almost priced at their net tangible assets. IVZ. Goodwill is 9 of this. Sells for $6 billion. It's actually 15, so there's no equity. Next. IZEA. Goodwill takes up, we'll say 5, 72 to 12. So 72 to 12 asset to liability ratio. That's really good. Giant accumulated deficit yet again, folks. That's insufferable. Equity of 64, plummeting. It deserves the 37 million market cap without even looking at earnings. Jan 1, GAN. Sells for $2 million. Keep that in mind. Total assets minus intangibles is 16. Total liabilities is 5. Giant deficit, huh? Yep, giant deficit. But why did their equity increase? Did they issue shares? So they made a big gain somehow. They issued shares. I'm not interested. JCTCF, folks. JCTCF, folks. This is the one that I had on the list already. And we're going to end this short segment with this one. But I had JCTCF on my best stocks going in. I own 0.8% of JCTCF, guys. And I bought 0.8% of JCTCF between a 15.5 and a $16 million market cap, right in the middle. So I'm up right now a good little chunk because JCTCF sells for 16.7 million today. I bought 0.8%, but let's look at JCTCF's SEC filing. If you look here, we got currents. It's all currents, 31.6. That's great. And then we have no intangibles really. Property and equipment pretty low. 37 million in assets. We'll say 36.5. Liabilities at 13. So equity of 23.5. And then look at this, paid in capital of only $1 million to $22 million of retained earnings. So this is a great business. This is a business that has grown from only $700 million. So that's exceptional. And then if we look at JCTCF, their earnings are great. Over the last 10 years, they top out at about 3 million. And then they've reduced their shares outstanding from 10 to 3. So this is the best stock that I've obviously seen so far. And I knew about this one going in. But yeah, assets at 37, liabilities at 13. So at 16.7 divided by 24, it's selling at 69% tangible book value today and probably still 5 to 6 times earnings. So I'd say JCTCF is still extremely undervalued. My fair value is 30 million. JCTCF is my best stock. One of my best stocks. Sorry, not my best stock. One of my best stocks. And so, JCTCF. Back at it, folks. I've got JCTCF finished. As we talked about, that's one of the most undervalued stocks, in my opinion, in the market. Next one is GOB stock. G Group. Selling for $60 million. Let's take a look at the assets. Goodwill takes up half the assets. 60 in assets after goodwill, 50 actually. Debt of 13, so shareholder equity of 37. Net tangible shareholder equity of 37. We have a deficit, and it's selling for 17 million. Sorry, it's selling for 60 million. I'm out, folks. Well above tangible book value. Jerash Holdings. All right, folks, I call Jerash Holdings one of the best value stocks in the market when it was at 40 million. And then I retracted, calling that a mistake. But right now I actually own part of Jerash Holdings, and I'm down about 10% on my stake right now. And so let's take a look at Jerash Holdings, JRSH. Now, the whole problem with Jerash is that this business does not do its operations in the United States. And it has, so we have a very good balance sheet, lots of cash, an excellent balance sheet, and that's what made it so attractive to me. But when you have an excellent balance sheet, but it's in a world situation that you can't trust, it's hard to justify the value. So as you can see, we have 79 intangible with only a little bit of goodwill, and then we only have 11 million in liabilities. And then as well, we have retained earnings of 46 million on a market cap of 36 right now. That's excellent. And they've only paid in 23 million. It's a very profitable business over time. You know, as I look at it again, it's so tempting to think that this is really undervalued. I mean, I would definitely say that Jerash is market beating at current levels, considering that we have net tangible of 68 million with almost no debt. They pay a dividend too of 7%, Jerash Holdings. Jerash Holdings. I would definitely say it's market beating based off of the balance sheet. And then if we look at their earnings history, Jerash has done quite well. Now lately they're pretty flat. They're going to be losing money starting next quarter on the trailing 12-month. But they had a really solid run from 2018 to 2022 of net income that probably exceeds the market cap right now. Shares outstanding, they reduced their shares slightly, but also have issued more than they've reduced over time. Yeah, Jerash, if we go back to their net income, let's see what they made. They were making $8 million a year. And so Jerash is still very interesting. Stocks to watch. JRSH. Going on our stocks to watch list. It's very interesting. Jerash Holdings, very interesting. The thing about Jerash, everybody, and I'm going to show you right now, is that they do their operations in Jordan. Their warehouses are in Amman. Let's see. They have warehouses in Amman, Jordan, and Hong Kong. But the thing is, everybody, their warehouses are like the problem is that it's not that the assets are undervalued. It's that they are, but we're not going to get the money back. And so they're taking our money from the United States. They're investing it into these places, but over time and overall, they're taking and just keeping the money, which can happen. But the thing is, the biggest shareholder of Jerash Holdings owns 50% of the stock. So that's one really good thing about it in my research that I found out. So Jerash is on our watch list. That's the best I can do. JVA. If I remember, JVA is not a business that makes any money. So this business, JVA, they're not making any money. They haven't made any money since 2015. They've lost money. But are they paying money out? That's so weird. So this is one of those businesses, guys, that doesn't make or doesn't pay out any money. Yeah, 24 million in shareholder equity, and they're not paying out any money at all. Yeah, JVA is weird. JVA is weird. I'm gonna put JVA on the watch list, or needs more research. Jackson Financial, JXN. I'm gonna have a feeling that they have tons and tons of liabilities on their assets. $314 to $304, I'm out. Assets to liabilities. Cayman Corp, KAMN. $1.5, but minus half of that for intangibles, $750 in assets. So no shareholder equity, negative 100 million shareholder equity after that's taken out. Next stock, tobacco stock, KAVL. $11 after intangibles are taken out, in assets, 4.5, sorry, 5 in liability, so 6 in equity with a giant deficit. What's their market cap? 12, fairly valued. KBNT, there's no chance at $250,000 that it's worth buying. KELYA, Kelly Services, 2.4. So $1 billion in equity. Sells for 740 million. A lot of assets and other assets undescribed. Strange, that's very strange. Current ratio is not very good. 1.5 to 1 current ratio. So, but here's the thing, guys. They've only paid in 30 million and the earnings invested in the business is 1.2 billion. So that's amazing. That's amazing. Kelly Services Inc. revenue. That could show us that it's a very profitable business. It probably is very profitable. Yeah, it's very profitable. Kelly Services. See if they've bought back any shares. They have bought back shares recently. Kelly Services. And when they bought back shares as it fell below book value, maybe? $13, it's at 20 right now. Interesting. So let's look at the 10Q again on this. We have, let's go through this. The Kelly's interesting. So Kelly Services, I'm thinking here, it could be, they could have a good margin of safety and it could be at like 5 to 8 times earnings possibly. It's a very profitable business over time. I'm taking a look here. So current assets, 1.6. Property and equipment, only 30 million. That's really good. Operating lease, right of use, only 60 million. Which this will never mean anything in the operating leases. That's just what the amount that they need in rent in the future. Deferred taxes, okay. Goodwill worth nothing. And then other assets. If let's do the math here, saying that the other assets are also intangibles and they're worth nothing. If that's the case, then we only have 2 billion in assets, and then 1.3 in liabilities. So we'd have an equity of 700. And that's a pretty good margin of safety. It's a very profitable business over time. And if they're making 700 in equity, yeah, really their normalized earnings over the last 10 years is 50. It's only about 50. So they're making 50 to 60, but I think their revenues are going to be they're going down. Yeah. So Kelly Services is going to be very fairly valued at 781 million because that's above 10 times normalized earnings, and that's just at or above tangible book value. There's nothing there. Feels very fairly valued. So if it was half that price, it would be interesting. KGEI. EL. Colibri. So I'm looking at Colibri stock. Let's see if we can get a picture here. Interesting. So Colibri Global Energy stock. It's a Canada stock. It's one that was worth pennies from 2019 to 2022. So this is going to be a business that sells and gains based off of oil prices, and I'm not going to be interested because of that. I don't want to look out or search out the filings. It doesn't matter. So Kraft Heinz, Warren Buffett bought Kraft Heinz, or owns a big chunk of Kraft. Let's see. KHC, I'm going to guess it's an earnings play. And so let's look here. They only have 20 billion in assets. And then 40 in total liabilities? Jesus, Kraft is way overvalued. They have not made money, they've lost money over, or they're even money over time, Kraft Heinz. Wow. Let's see here. Yeah, Warren Buffett, I don't know what he was thinking. I don't know what he was thinking. Because at 40, it feels overpriced right now by a lot. Negative shareholder equity of 20. Kraft Heinz is a disaster. Holy shit. KODK. Eastern Kodak. Total assets 2.3. And I believe this is selling for 300 million. Keep that in mind. 2.3. So their assets, half their assets are in pension and other post-retirement assets. Yikes. That just... So they've lost a lot of money over time, accumulated deficit of 500 million. Shareholder equity of 900 million. But if we look at their earnings, Eastern Kodak, they're losing money over the last 10 years. Shares outstanding is not being reduced as the price falls. Let's take a look at the price. Yeah. Yeah, unfortunately, they're not going to be able to get value out of those pension assets. Like, yeah, I'm out. I'm not interested. Koss Corporation, KOSS. Total currents, 27. Other assets, this is a very clean asset sheet. 37.3. Total liabilities of 6. Okay. So very good. This is a very good balance sheet, everybody. We have paid-in capital of 13. We have retained earnings of 18. So total shareholder equity of 31.2. Now that's good so far. Everything looks good. What is cost selling for? 25.7. So that feels undervalued. Costs, revenue over time. Revenues are going down. Ooh, and they're not very profitable over the last 10 years. We only have this one gain, whatever the heck that was. Are they reducing shares? No. Cost stock. Yeah, guys, this one, yeah. Fairly valued at 26 million for me. KRC. Realty, this is going to be a REIT. Buildings, land, most of the assets at 10, and total assets at 11.4, total liabilities of 5.8. We've talked about this. If their assets, if their real estate properties are worth 50% less, the company is worth nothing. Or the position will be worth something, but the equity is worth nothing. So paid-in capital with almost no retained earnings. 5.6 in equity, and the current market cap is 3.6. And I'm going to guess earnings are expected to be much below, like it's going to be at a very high multiple to earnings adjusted for how they're going down in real estate. Let's take a look. Kilroy Realty revenue, constantly increasing, but that's going to be as a result of the real estate bubble in a sense. Kilroy Realty. They do make consistent net incomes. No reducing of shares outstanding. They're making 200 million, 250 in net income with the real estate market that we're in. Let's see. We'll give them 250. That's going to make the current market cap pretty fair at 3.6. So 13, 14 times earnings. That's very fair. I'm not interested. KVHI. It wasn't anywhere near being below liquidation value. Total current assets, 130 million. Property and equipment, that's a big chunk. That needs investigation. No intangibles, so we have 186 in assets. Total liabilities of 29. Very small, very few retained earnings, guys. Lots of paid in capital, so they haven't made much over time. Equity of 157. And it's selling for 94. I've got a feeling earnings are not good. Revenue for KVH, they've been in business the last 15 years and they've generated nothing. Just 2 large gains, and besides that, nothing. Shares have increased. Wow. And I'm gonna guess they can't, yeah, they're unable, the stock was overpriced the last 10 years, undebatably. It's still overpriced now, KVHI. If they're not gonna return that money back, then those assets are fairly valued at 90 million. Lakeland Industries, LAKE. So Lakeland Industries. Assets 133 after intangibles. Total liabilities of 26. So total equity of 109. This is good. They have good retained earnings. Looks like they made money. Lakeland Industries 109 or so after. So it's at tangible book value. I wish it was cheaper. LAKE. LAKE. Trying to find it on macro trends. Here we go. They haven't made much over the last 10 years. Maybe on average 1.5 million. So it's probably overvalued at the current moment by a lot too. Lakeland Industries. All right. Next stock is KGEI. No filing. Colibri. Colibri stock, dang, no filings here. Oh, we already looked into this one. Yeah, guys, it looks like had some stocks added to my list here. So we're actually down here below Lakeland. We're at LASE. Laser phonetics. Um, 14 in assets. Total liabilities of only 800,000. So they have equity of 13 million. They've lost money over time. They're losing more money. So total equity of 14. Sorry, I mean 13. Laser fun. And it sells for 6. Okay. This won't tell me their net income. Sorry, guys. I'm just going to skip because they have a deficit. It's hard to find filings on stocks like that. LC Lending Club Corporation. $8.4 to 7.2. I'm not participating in weak margins of safety like that. Bank skipping. Lendway, LDWY. Da, 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 da. So Lenway has not generated any net income the last 10 years, 12 years. Shares outstanding, flat. Yeah, it deserves to sell below book if they're not going to return anything. Lenway pass. LE selling for $223 million. Lands End. So they have 750, 650 in assets. Total liabilities of 650, so they have no equity. I'm out. I'm going to skip Logic Mark. I've seen that one before, and I know it's going bankrupt. LMFA. Current assets, fixed assets, whatever that is. Total assets of 338. Total liabilities of 2. Giant deficit, everybody. I'm not participating in giant deficits that are getting bigger by 13 million like that. I'll pass. LM funding, bank pass, LNSR. Let's take a look. Total assets of 60. Lots of current assets, which is great. 60 over 24. So total equity of 30. Whoa. Oh, a giant deficit. Jesus. Paid in capital of 143, deficit of 110. I'm not interested. Lensar, Lake Court Pass, LSEA. This is going to be a REIT. LSEA, Land Sea Homes, live on the sea but on land. $1.4 billion in assets, 800 in liabilities, weak margin of safety, meaning if their assets or their real estate were reduced in value by 30 or 40%, they lose everything. They don't have any equity. And so they do have retained earnings. Fancy that. They're probably a home builder too. All real estate and home building profits are going to be inflated by 3 to 4x during 2021 and 2022. So I'm going to take this and divide it by 3 or so. I mean, I'm being generous if they make 20 to 30 million on average. I'm being generous. They did reduce shares outstanding. So market cap 370. That's going to be fairly valued, folks. That's going to be fairly valued. And let me explain why. With the real estate and the home builders, like in 2008, if their inventory goes down just 30% or 40%, they lose all equity and the business is worthless. And so that is your bet here with Land C. It doesn't matter how much money they make. It matters how volatile the price is going to be on the real estate and compared to what they reported as. And for these home builders, they typically report it as what the price is worth right now to somebody. They don't carry inventory for 10 years. Whereas with a stock like JCTCF, you'll see them buy a property in 2001, report it as $1 million worth of book value, and it's worth $4 million. That can happen. But that's not what's happening with the home builders. The home builders are reporting it for what they built it for at the moment. And home builders have a long history of disasters. And so if you're going to mess with a home builder, if they have a lot of debt compared to equity, you have to consider that any fall in price in their reported assets is going to trigger a complete loss of equity. And they could have gained that equity for 50 years. And there's no difference between 50 billion of liabilities and 50 billion of assets and $2 of each. They're both worth nothing. So always remember that. Laird Superfood, LSF. I'm going to guess a giant deficit. Giant deficit. This business is right up the road, everybody. Yeah, look at this deficit. They paid in $120 million and they've lost 110. That is insane. Holy shit. Oh my goodness. Laird Superfood. Bankrupt. LTRY. Lottery. So they have prepaid expenses. Total assets of 36 after the intangibles are taken out. Total liabilities of 21. So that's total equity of 15. 15. Paid in capital of 270 and they've lost 220. That's embarrassing. They've actually lost almost all of it. This business is going bankrupt. Lottery, LTRY. Without a shadow of a doubt. So these two banks, skip. And now we're on to MCS Marcus Corp. So their whole assets are going to be worth so they have 670 in property and equipment. That's almost all of their assets. 1 billion in assets over $500,000 in liabilities. So 1 to 1.5, 2 to 1. And it's a movie theater business. They do have retained earnings, everybody. So see how they've paid in 159 million in capital and they have retained earnings of 285. That's really good. Marcus Corporation. It's selling at book value, everybody. That's probably going to be fairly valued. Let's check earnings. Yeah, it looks like they were making trailing of 40 back in the 2015 era, which makes it fairly valued today, and they've even lost money recently. So even if they've returned to those profitability levels, it's fairly valued today. Very, very fairly valued. No increases in revenue, really, just a slight increase. Marcus Corporation, nope. Hey, it's a good business from the perspective that they built it off of retained earnings. Pediatrics Medical Corp, MD stock. assets, total assets of only 750 after goodwill. Oh my gosh, they're way below tangible book value. Pass. MDC stock. MDC Holdings, it could be a conglomerate. Total assets. Another REIT. 5.4, no intangibles. To 2. So that's a good ratio to have a 5.4 to 2 ratio in real estate, because that means you're going to have to get close to a 60 to 70% discount to lose your equity. MDC Holdings, that's a better margin of safety than we've seen with other real estate stocks. And as well, they have a lot of retained earnings compared to paid-in capital. So MDC, what's the market cap? Oh, it's going to be fairly valued compared to their assets at $3.2 billion and 3.2 in equity. Oh, well. MDVL. $29 to $6. With a giant deficit of $260 million, I'm out. ME. We've got 400 in assets, 23andMe, 175 in liabilities, 225 in net equity with a giant deficit of 8 times that. So I'm passing on 23andMe. MEI stock. MEI, Methode Electronics. $1.2 in net tangible assets to 641, 570. We do have an amazing retained earnings of 764. Okay, wow. So this is a very profitable business. I'm impressed here. Let's look at this again. 550, so there's $1 billion in assets, and a lot of those are currents. $1 billion in assets, a lot of those are currents. Total liabilities of 641, so a weak margin of safety. It's a 1 to 0.64 ratio. So if we lose 36+% of our asset value, we lose all of our equity. But it is current assets. So, trying to figure out shareholder equity. I got lost for a second. It's minus 550. So, 380 in shareholder equity. What's the market cap? It's double that, so that's fairly valued. I don't even know why it was taking so long. MEIP. MEIP Pharma assets. 101. Total liabilities of 19. Giant deficit. Jesus. 349 in deficit. When they make all their revenue from collaboration agreements, it's very inconsistent. That's most pharma and biotech businesses. So I'm going to just skip. MEI with such a giant deficit like that, I'm scared. MFIN. 2.6 in assets, 2.1 in liabilities. That's a weak margin of safety. I'm out. Bank Corp skipping. Mohawk, MHK. $12 billion in assets, $6 billion in liabilities. That's got us at book value. They have built their business out of retained earnings, so it's very profitable. $6 billion is the market cap. I'm going to need to see proof that they can make over $1 billion in net income. Yeah, with revenues topping off, 8 to 11. I'm not too excited about it. They have bought back shares. MHK stock. Mohawk Industries. Oh, actually, shoot. I like this. Mohawk Industries. For $5 billion. Stocks to watch. I'm taking JRSH off and putting it on riskier cigar butts. MHK. So that's a business that could achieve a margin of safety if it dropped 50% in price. If MHK went down 50% from where it's at, it would be extremely interesting. That's where you want to pick that thing up. So MICS. The Singing Machine Corporation. 30 in assets. 22 in liabilities. That's a very weak margin of safety. It means a 30%. And then we've got a giant deficit. 30% discount, loses all of our equity. I'm out. MIGI. $87 to $47 in liabilities. If you lose 50% of your asset value, you've lost all of your equity. It's an okay margin of safety. And a giant accumulated deficit for Mawson. So I'm going to be out. Something is seriously wrong with their business. Minim, M-I-N-M. Total assets of 23. Liabilities of 16 with a giant deficit. If they're losing hand over fist, it's probably worthless. M-I-N-M, worthless. MKFG. $257 to 86. That's really good. So a 3-to-1 asset to liability ratio that gets even better without the lease liabilities. Damn, accumulated deficit of 190 million. That's devastating. That's devastating. I want it to be profitable. So it's going to be very fairly valued if they're losing money like that. You can tell just based off of looking at the 10Q. Banks, Mobiquity, Only selling for $1 million. We'll take a look. Negative shareholder equity. Banks. I think we're on Mosaic. MOS. Mosaic Company. $1.1 billion in goodwill. We'll say 21 in assets. $9 in liabilities. Sorry, 10 in liabilities. For an equity. Wow, they built the business out of retained earnings. So this is a very profitable business. Very profitable. Total equity after goodwill is, they have a lot of property and equipment, which is very concerning. Mosaic, total equity is going to be 11. So, it's above book value. Yeah, it's very profitable. So that's one good thing about Mosaic. And then definitely fairly valued up at $12 billion. So not worth it. MPAA, motor parts. Let's take a look at motor parts. MPAA. What's the market cap? $200 million market cap. So we have currents of 600 million. Okay, almost no goodwill. So we have $1 billion in assets with almost no goodwill. And then we have currents of 462, 424. One concerning thing is that the current ratio is not very good. Actually, it's okay. 544 to 424. No, that's not good. That's not a good current ratio. So total liabilities of 761. So in this situation, if your assets are worth 26% less in a liquidation scenario than what they're reported as, you don't own anything. But let's see. Okay. So they've paid in $200 million, 234, and they only have retained earnings of 85, which is not great, but that is profitable. They could be hiding their earnings and their assets, though. MPAA, revenue over time. Increasing revenues really strongly, too. But they're not generating any net incomes. So I'd be scared that you're looking at a business that's secretly losing money. They're issuing shares too. And it's too indebted. There's a very weak margin of safety on MPAA. So I can't take that risk. I'm looking for something that can lose asset values in a liquidation to the rate of 40, 50% and will still come out on top. But with here, it's got too weak of a margin of safety. It's too risky. And then you'd have to believe it's selling for 200 million. You're going to have to generate some large net incomes to buy back shares. Like all this shareholder equity could be nothing. So MPAA, not a strong enough margin of safety, not strong enough earnings for me. Next, MPB, that's a bank, we're skipping banks. MRIN, Marin Software, only selling for 6 million. That's concerning because it costs a lot to list alone. 25 to 6 with a giant deficit. Look at how big that deficit is. So this business is going bankrupt. $348 million loss. That's insane. Marin Software.